Okay, good morning, everyone. Today is the 15th of April, 2025, being Tuesday, day 2 of our finance for non-finance professionals and managers alike. Okay, today we'll start with the core accounting. This is going to serve as fundamental point towards developing that area, not especially performance management and corporate finance, tax management, and also in other aspects in project finance and investment appraisal. Okay. Now, we'll be looking at these branches of accounting. Again, I think I'll let you know that accounting have different branches. Okay. Who can tell me what are the branches going to be? Branches of accounting. Bookkeeping is part of financial accounting. Okay, let me say bookkeeping, financial accounting. Which accounting branch do you know again? Tax accounting, yeah. Management accounting, cost accounting. Which area? Auditing. Financial management. Financial reporting, there is an extension of financial accounting. Which other one? Forensic accounting, yeah, but forensic accounting is also part. What other one? Public. Public accounting. Public accounting. Okay, public sector accounting. Yeah, public sector accounting, or what we call government accounting. Okay, public sector accounting. Which other branch is not to you? You are going to win money today. No, we'll discuss. Sustainability reporting is now another new branch of accounting. There's another one.
Energy account.
Land account.
Land is government. No, we talk about government accounts. Talk about tax. International. Which is international? I don't know if they use. Fiduciary account. Account is always about fiduciary. It's about stewardship. Okay, there's integrated reporting, which speaks to integrated thinking.
I have questions.
Okay, therefore, accounting is very wise. Very, very what?
Why?
And that's why we have specialization of what? That's specialization. Okay, that's why today, some aspects of accounting are known as FP&A. Accounting. Planning and accounting. MIS analysis. Yes, an analysis. No, BPM or MIS, whatever you call it, is one aspect of that FP&A. Now, conventional accounting organization are not divided into two: FP&A and financial control. Okay. It's in financial controls, you have the general accounting, you have the, what's it called, tax management, you have the likes of, treasury falls under FP&A, corporate finance falls under FP&A, budget planning, performance management falls under. Okay. Now, let's start with what matters to us. We'll be looking at these three things: bookkeeping, financial accounting and financial what? Reporting. Okay, now when we talk about bookkeeping, it's just what the name depicts. Keeping of what? Records. That's what bookkeeping is all about. Keeping of what?
Records.
And what form of record do you keep? Yeah? Okay. All form of records of business activity, both financial and what? Non-financial, but it's more of financial what? Okay, because every transaction has implication, has accounting implication. This trading we are doing, it has implication. What's the financial implication of this trading we are doing?
Time.
No? The money is friends. This madam came to meet the I won't tell you how much you collected. I'm already calculating. I told the time I didn't eat breakfast. I didn't eat. Therefore, they will come and account for how they spent the amounts. I'm counting it, and I've counted the idea that is 500 because I've seen the number of pizza. I'm counting it. When you do retirement, now say no. This thing we have to audit it. Okay, bookkeeping, as I've said, is about everything we have done here today, no matter the value we take away, there's an expense that have been incurred, which affects the profitability. No matter how, the amount you have spent will reduce our profit by the amount you spent. And that's why we always have to look at it. And at the end of the day, maybe we will not contribute additional revenue. It will increase our profit.
Yeah, because the essence of it, make us better.
And that is if you actually take something out. I know that you can even take something out and you don't use it for the sample.
Use it.
You know? Okay, now when you look at bookkeeping, it's just that it entails day-to-day record keeping and record processes. Every day we involve in one transaction or the other, one department, one function, the source of things, and that. You now find out that all of those transactions are recorded somewhere. Okay, and the source of recording is to obtain what we call source documents. What? Source document means the transaction you have incurred came from the source, have you? You want document from that source to justify that what? Transaction. And that's what we mean by source what? Okay, but much more, you get things like give me supporting document, which is empty as source what? Document. Because when we want to process transaction, you must have at least a document that reflects that transaction before you enter it into the accounting system. Before you enter it into what? Accounting system. Okay? Because any transaction you post in your accounting software or ERP or anything that's not backed by source document is known as dry posting. Known as what? Dry posting. And dry posting is an offense. Does it mean there's no transaction? You just said post and you can use it for fraud. You can use it for what? Fraud. Okay. And that's why you find out that at the end of the day, when you process transaction, debt account, you call an external auditor to do what? To examine it, whether all is what? Well, okay. How do we justify this transaction? And when they are put on inquiry, whether internal or external, they can also now carry out investigation on the document, whether it's even genuine, who even gave the approval. Is that expense also available? Is it even for the purpose of the business or that is like that? The essence is that so that we can always know for sure what's the position of the business in terms of purpose. Okay, as I've said earlier, now for bookkeeping is a starting point to enter into formal accounting. Okay, because bookkeeping border much more on gathering those records and putting them into the work system. But accounting takes further steps towards processing those information towards producing financial information. And financial information is a source of information in which users of financial statements make what? Make what? Okay, now, most of you here, what you are always exposed to are the final output of accounting or financial reporting, which is the financial what? Statement. But there are 1,001 things that go behind that's not happening. And if those 1,001 things are wrong, no matter what you do financial data, you're analyzing and you're taking decision, you're on your what? And that's why you find out that when company is coming to the market to list or to do anything, you also need to do due diligence, you need to get a working accountant, auditors, and some other things have to reevaluate it to be sure that those numbers are okay. Because many people rely on it. And even lives will be based on it. Because imagine you use your pension to invest on fictitious numbers. Wow. Yes. Where is the person I was talking about real estate or something? Someone collapse. You don't see the year of the collapse. See bets. You don't see it, I has collapsed. Hope your money is not there.
When did it collapse?
It's your money. No.
Somebody has been asking me to come and face it.
Okay. Now, also we now have financial reporting. Financial reporting is just an advanced aspect of financial accounting or financial statement. Okay, that's where you try to more or less present information in a manner that will aid decision was. Okay. Now, but today it's understanding the basic concepts and principles in accounting. Now, let's look up. This is the fundamental of accounting. Double what? And it was dated back 1494. Can you think where you were in 1494? Perhaps some of you came in as ants. I mean, I didn't account yet. When we start accounting, for you to see number well. And you can't say accountant, you say I like it. Because when they see this. You know, accounting is sweeter now. Those days, many accountants end up in jail. It's a fraud and organization, and accountant must go whether you are involved or not, because it's past through. That's why those days people will even say they used to juice, but most time I don't think it was juice. It's because they distract you, they game you, and that's why you see that a good accountant must not be too friendly when it comes to transaction. Do you know what I'm saying now? Because you have to look at it with equal eye, and you have to. That's why you see that every good accountant, when you are rushing for something, you say, okay, calm down. Because you are the last point of control. Once it's escape. And if there's problem, you are the first to be carried. Okay, double entry principle. It was a principle introduced by an Italian monk. If we can get the name of that monk, I'll give you something. It's not Luca Pacioli. Reverend Lucas Pacioli.
What do you know?
I said Reverend, it was quiet.
Okay, then. You know, I was working. Someone was.
Comrade, I said Reverend, it was silent.
That's she got it. No, the nigga is secret Reverend.
To love Reverend.
But because he's smart, I'll give you something. I'll give you $1. Comrade, no.
Comrade, right now.
You know, I told you that I have to take it before I make it. Now, double entry principle also mimic the principle of head and tail. To every coin, there are many sides. Things. Okay, therefore, all people say that for every transaction, there are two sides. The debit and the what? Now, the net debit and credit is what it debit. It's not that it means anything. It's just I think that there are two creatures, man and what? A woman. It's the name they gave, I mean. Just take note that debit is a naming convention, and credit is also what? Naming convention. Okay. Now, what then is this? Is that for every transaction, there are two sides to it. The size of the giver and the size of the what? Because you can't do transaction with yourself. You must do transaction with somebody else. Therefore, that person against you. Okay, which that means that one side will be debit, one side will be what? Credit. The question then is that which side will be debit or credit is a function of many things. But the beauty of it is that even though I'm laying the principle with double entry, but we are not going to be discussing debit credit again after this discussion. Rather, is the impact or effect of debit and credit we will not be discussing, which make you understand business implication of every decision you make. Okay, now it's saying primarily that for every transaction, there is a debit and a corresponding what? Credit. Okay, and we went further to simplify it. It's okay. For every receiver, we debit, I mean, for every giver, we what?
Credit.
This thing always causes confusion among accountants. Because when I get certain level, now say, am I the receiver, am I the giver? That's where the problem starts. But again, that methodology is going because you now find better ways of explaining that. Okay, and which are. But before then, we need to understand that there's this first accounting equation, and very critical. And what is that equation? It says that asset equals what? Equity plus what? Liability. Now, we then need to start to pick those terms. What then is what? An asset. What then is what? Equity. And what then is what? Liability. Okay. Now, in simple terms, when we say assets, before now, some of us grew up seeing asset as something that is tangible. When you say assets, first you say a table, motor vehicle, house. But in today's world, it has gone far beyond that. Don't be shocked that this table might not even qualify as well as assets. Therefore, what is an asset? Now, today, we see an asset as any form of economic resources, any form, which means you have expanded the scope to include both tangible and what? Intangible. Anything that can bring about economic work, because which results in an inflow and burdening economic work benefit, which is anything that can always give you value as an entity is your asset, which means intellectual property is an asset. Why is it that how many of you are into music? What's the greatest asset in music?
Your
Voice.
voice.
No.
So your music.
No, royalty is the economic benefit.
The song,
No.
Your name.
Music right.
Eh?
The master.
Eh?
The master.
No, it's a catalog.
Another.
You know that you might be a musician if you don't own your catalog, don't have that intellectual property.
Yeah.
That's what is causing problems now, that people are now aware of catalog. That's why most of people just sign contract. And again, because you don't know that you have that potential to blow. It's not enough finish slowly. You have to have-
That's the actually me.
You can see now, catalog is intangible.
What is it?
You can see, that's why there are many old musicians today, they don't own their catalog. That's why they were.
Sure.
Whereas the person that owns that catalog has died, but the children are still
Still cashing out.
Whereas the musician, you know, this person was saying, who is this person? Don't bring up. Now, everybody is not conscious. That's why I see that every musician now is now his own record label. You can see now. Okay, and that's just the beauty, which means assets include both tangible, intangible investment and the like. Whatever is within your reach, legally, take note of it. Legally, that will always draw economic benefit what? Now, what even complicates it a little now is that asset is not necessarily those things you own. Which means it's not limited to what you own. It also extends to what you have control of. What that signifies that there are situations where you own an economic resource, but it's not your assets. And there are instances where you don't own it and it's your asset. The question is, who has control over it? That's why I use this music talk. You sang a lot of songs, but is it your own? Even movies. It's not that YouTube has made everybody producer.
Yeah.
Movies, executive producer owns it, have you?
Yes.
You know, they might say you are the producer because you wrote the stuff for us.
Yeah.
But executive producer owns it, have you?
Yes.
That person have the rights over it. You can see now. The question then is, you might write a movie, but you don't have the money to produce it. And the arrangement is that this person takes the risk. You are not borrowing from that person. The person is putting the money there that if the movie flow, it blows. If it fails, it fails. That's why you see that some people, when African Magic came in, and even YouTube now, all those old movies, they are still bringing it up. How many of you watch Tulu Anile? You know what about Tulu Anile? You will watch it. That's many of you probably are not born then. That's yes. Eh? Yeah. It's before 95. Okay. You even know it.
You want to back? This is the collect. It's been downstairs.
Now, the movie was so powerful that all of us thought Baba would be a billionaire. If you watch the stuff last year, we were about setting with a mainframe. But he said he didn't even end. It's like a cheating. But it's not a cheat. It's depending on what you sign. Because they took risk. It is not something flow, you said it.
Yeah.
Artists are not going to sponsor that money
Just went.
went like that. What the movie is very interesting. And if you want to watch it at night. Why? Eh?
Is that that's a guru pass?
I say watch it. No, watch it alone or what? But it's very interesting.
Very, very interesting. But not
Okay.
That's the list first.
Now, we can speak to the fact that when we talk about assets, your focus should not be restricted to what you can see. Is what you can see the economic resource in the hand of an entity, whether they own it or not, but they legally have control over it, and it will draw economic what? Benefit. Because that's the only reason why it's an asset. The benefit it will give. You can say now, the benefit will give me. It's not that sometimes that's why some people will tell you that owning a car may not be an asset. But technically it's an asset, but if it give you more of say than because a liar.
I remember all this. I can't remember the name. I can't remember what happened. I don't know what this is. It was crazy.
Yeah, now.
You love to Jimmy. Jimmy. Hey, laugh.
Let me see, man. What is that about?
I thought you knew and I remember.
He's on.
Even me, I think.
Now, let me now show you a practical example of asset that you might control, but you don't own. Majorly, a typical example of that is asset under lease. Asset under what?
Lease.
Therefore, if you lease an asset and it meets the necessary requirement, it is now you that you are in the seat. Like it means the technical borrower of the assets. Because that's the person that is getting the economic what? Benefit based on the fact that you have paid the rights, the lease rent, therefore it becomes asset. Before we can put it as assets or PP or whatever, but now we put it separately as right of use asset. That's why when you see financial statement, you start to see ROU. Start to see what? ROU. Okay, open rank. Open 2020. Plus. Go to the page 28. 2020. You see ROU. That's right of use of an asset. Okay. We put it as an asset.
I don't have to.
Now, anytime you see ROU asset, knows that this is an asset you control by way of what? Lease. This 20. Where's your 20?
They don't give me now.
No,
But they give everyone.
Everybody.
And I took everyone.
Ah.
the other one. Therefore, somebody else will have one. Who has one instead of two?
Mine's number.
Huh? Okay, that's your own. You do have one now. Therefore, you don't have two. That means you have two. Okay, that's ROU what? Asset. Now let's go to note 17.1 and read about ROU assets. 17.1. Now you start. I'll force you to know how to read financial statement. 17.1 in front of it means note 17.1. Don't follow the notes.
60.
No, follow the notes. Don't wait for my page. But me, I'm getting there. It's page 60. You need to start to know how to reference. That's reference. Okay? Okay. Now, who has a lovely voice here?
Hi, sir.
Hi. Hi. Read.
I should read what?
17.1, the old notes.
Okay, right of you. Balance as at January 1, December 48.6 million. As at the end of 2019, it was 71.5 million. And then charged to profit or loss as lease rental for the year, 17.3 million for 2019, 22.9 million for 2019. Do I continue?
Yeah.
And then the balance as at the end of the year, for 2020, 31.3 million, for 2019, 48.6 million. Continue?
Yes, that's the main one I want.
This represents payments made for lease of service station.
Most of those stations are these.
Yeah.
Okay. How many of you are involved in Ashadu Synergy affairs? Now, past or now? You know, there's this code in here, Dodo, Kodo.
Yes. Yes.
Oh, yeah. What is Dodo? What does that mean?
Dealer operating, I get it, yeah.
Dealer is the one that is managing. Okay, in that case, we don't have any asset there.
Yeah.
We only supply products. Kodo.
Company owned dealer operator.
And most of those company owned, we might either own that place or we might also lease that place from a separate owner. But it's what's it called, that operations. What about Coco?
Company owned.
Company owned operator.
We never had any Coco, has it?
So we have.
We have that.
Omago.
Oh my God.
Omago.
Are we the one operating?
No.
Our staff?
Oh, yeah.
Is it our staff, and is it also our P&L for it, or is the customer supply?
The dealer.
Apologies.
Because it's more of edit. No, everybody has his own area of specialized. You can't be managing that and still managing petrol attendant and every other thing. Okay? Oh, yeah, continue.
There are no additions to right of use assets during the year. The depreciation charge of 17.3 million is included in administrative expenses in the statement of profit or loss and other comprehensive income. C, the company has leases for some of its retail outlets, with the exception of short-term leases and leases of low value underlying assets. Each lease is reflected on the balance sheet as a right of use asset, and no lease liability was recognized because the full lease payment for the lease period was made to the lessor at the contract inception. Each lease generally imposes a restriction that unless there is a contractual right for the company to sublet the assets on that party, the right of use asset can only be used by the company. Some leases contain where the lessee is desirous of renewing the lease. A written notice to that effect shall be sent to the lessor, who, when certified, shall accede to the renewal with the liberty to call for a revised lease payment and other conditions to meet the exigencies of the material. The company is prohibited from selling the underlying lease assets. It is also stated that the company must keep those properties in good state of repair and return the assets in their original condition at the end. D, no impairment charge on leased property during the year. Also, in respect of the proposed winding up of the company, the management of the company has initiated the process of transferring the right of use assets to another entity as a means to recovering the remaining lease amount paid on the lease arrangement.
Okay. Now, it's just for you to understand that there's a business activity that gave rise to this. Okay? Accounting is always the consequence of your decision, of your action, of your reality. That's why we say it's a stewardship of accounting. Stewardship, which means I'm a steward. And thereafter, I have to give account to my master to say, this is how I spend your money, this is what happened, this is the result, and also things like that. And therefore, accounting should reflect what has happened. Therefore, it is not to sugarcoat what the owner wants to see. If you sugarcoat what the owner wants to see and not what has happened, therefore, we'll call that creative what? Or what we call shina, or what we call cosmetic what? Accounting, or what we call window dressing. All of the 4 things I've mentioned revolve around a gender.
Seller.
Who window dress? Dressing. Is it for man or woman? Okay.
Today's word.
Creative. Who is more creative between man and woman? Shenanigans. Say shenanigans. Okay, cosmetic accounting. Who use cosmetic? Which means, what we are saying is that when you start to package accounting, packaging, who is used to package? I think we use you to say that, okay, which means that's why sometimes people don't want to present it the way they are, and it's more dangerous. You know why? Because you are deceiving yourself. If you present it the way it is, now start to change the way a manner to take future decisions. Men with depression does not solve your problem. It's like if you are thinking of series of problems, you are depressed, and you are now taking alcohol to erase depression. Does it make sense? It makes sense. After the alcohol, the second day or third day, what will happen to your depression? You take it again.
But without the alcohol, they will have been done all true.
No, the question is, what is the solution to depression?
Alcohol. Keep drinking. Just keep drinking.
Show that none of you have entered depression. That depression is about what? Alcohol. No, you have to combat your problem head to head. Yes, sir. Because that will not solve your problem. It's only going to, and that's why you see that many people get destroyed at the end of the day unintendedly, because they are depressed, especially the Gen Z people. They now enter different jobs. I saw one 2 days ago, now balloon.
Yes, I saw it.
Is that laughing gas?
Yeah.
How do you know? Opinion.
Yeah, but they put balloon.
Because
It's 5
lady, and the other person will say, that means that if you get for some of it, say, guys, we blow this. But the reality is that you need to present information where they are. Therefore, in future, when you don't like that result, you then sit down and plan. and started counting. For the public to do what? So that the public will come and potentially.
That's not legal. That's not legal. That's not legal. You can't do two.
Wait. When you do cosmetic for the public, what is your intention? And what will be your gain?
You said that you have for future decision making.
Why do you want to package?
Because I need to attract investors and fix the problem that I have.
Now put yourself as the investor.
That's another way to look at it, but I mean, from my perspective, it's a possibility.
At the end of the day, it doesn't pay anybody. In the long run, nobody has.
Sometimes you have done some.
But it doesn't end well. How many of, okay, I'll give you a tax against tomorrow. How many of you know about Aaron? Aaron Handler.
Huh?
Aaron.
Due to parallax.
It's what?
I'm rejecting a lot of error.
Aaron.
Okay.
Anderson.
Okay, what about what Okay, Aaron case was, I think it was in 2000. Welcome was 2002, I guess. Go and look at it. Understand? What about, how many of you know about Lehman Brothers? Lehman Brothers. Yeah.
To be never brother.
Not Unilever.
Not the
Never brother now.
No, not Lehman Brothers. I'm talking about Lehman Brothers.
Oh,
What do you know about them?
Okay, so they were part of the course of 2008 financial
Speak
crisis.
to man.
Okay, I said they were a major cause of the 2008 financial crisis. I think they are investment bankers and they were giving people money and they knew people couldn't pay. So they were just giving people money out. And when people could not pay back, financial system crashed.
Now, Lehman Brothers and some few had the whole global and global economy crashed because of what? Because of a risk I mentioned yesterday. What's that risk? I'll give you something.
I know something.
What was the risk?
Was it mortgage?
Thank you, sir.
Mortgage.
No, the risk. No. The instrument is subprime mortgage, but I'm saying the risk that would. Okay, what is the risk that if Dangote failed today, many companies are about to go with it?
No.
No, there's this risk. Contagion risk.
Contagion.
It's the same thing. It's
I can see it somewhere.
I'll remove your eyelash. Okay, my back. There are some risks that if your customer fails, it can overrun your business. And if some other company fails, that's why one person that I know that people are praying for, that is going to be difficult for that person to die young, is Dangote. You know why? Because it's indebtedness. Every bank will pay for him because if Dangote fails and things scatter, if there's no governance structure, I can tell you one or two banks will go. And if a bank go, it may affect you.
Which bank is that?
Access.
Why are you saying access? You also have more money than them now. Before you know, some customers that have money can't pay Ashami can't pay. Everything wrong. Yes, everything. And in that situation, people will have to step in immediately. Because that alone can cause panic pandemonium. And that will call bank run. What's bank run?
Bank
Run.
What we just said now.
What's background? What's back?
Customers come to collect their money almost all at once.
You know, there's no bank in this world that can survive bank run. Because the question is this, bank tells you that they have deposits of 4 trillion. Does it exist physically? No. But it exists where at least 60% of it, if you consider 40% cash reserve ratio, is in the hands of companies by way of borrow. Therefore, would they not call all of the borrowers? Therefore, one of the risks that bank, CBN always protect that as government of the world, bank law. And that's why they quickly step in when they are fake news. Okay, go to this bank, go and collect money, they step in because even if that rumor is false, then you could kill. Yeah, open to.
Okay. And like, yeah, some people said something like if you have like.
Yeah, that several.
Okay.
So people have been taking out, so now they're doing so much ads, like they're saying, oh, they're paying influencers to come and say in line, that they're the crisis for the crisis.
I think it's just the commercial bank.
Okay, now let's talk about equity. I think we are clear about asset. Let's talk about equity. What is equity? Equity is not capital. But initially, equity starts from your capital contribution. But over time, your equity grows or diminishes based on your performance. Which means technically equity is not capital plus retain what? Earnings and other reserves. And retained earnings are internally generated through profitability. Which means your equity is always what is left from your assets if you have to settle all your liabilities. That's it. And that's why your equity will grow if you continue to perform positively. Your equity will diminish if you have lost what? But equity are considered as owners' stake in the business, which evidence residual what? Interest in the net what?
In the net what?
Assets. And what is net profit? Is when you take away all liabilities from the entire what? Asset. And equity is expected to be positive if you have more asset than liabilities, but it can equally be what? Negative. Your capital can be negative, but your equity can be what? Negative. Why will capital not be negative, but equity is negative? What do you think about that? No. Okay, equity is negative, but capital is always positive. What would now make equity negative when capital remains positive? Accumulated what? Losses. When your loss wipe out your what? Capital, your equity becomes what? Negative. Now, the next one is liability. Now, as to assets, is to liability. Liability is where you have a present obligation, which always arises from past events, which means probably you bought something on credit. Probably you have tied up activity that exposes others, and you have constructive obligation or legal obligation to pay, compensate, and not sort of thing. You get what I'm saying now? Those are your liability. And liability always take out the economic resources. Your asset will bring in economic value, but liability will take it what? Out. It always results in what? Outflow, embodying economic what? Anything to which legally or constructively you are bound to pay by way of cash or other financial assets as a result of what you have done yesterday, today, or the day before. It becomes liability. Okay? Because is a debt that you must pay. Whether today or you pay it what? Tomorrow. Now, the first equation says assets equals what? Equity plus what? You know that we can reorder the equation. We can what?
Reorder the equation.
Reorder the equation. Let me try and reorder it.
Yeah.
You had that. Is the name Angie? Angie Brown. Huh? The name Angie.
Actually, I'm not very best. Maybe so.
So when you come Angie? I was so confused. I was like, don't have any middle name or something. Like, this is the first time I'm going to see where we go. I'm like, huh?
Oh, yeah.
Why you be opening your mouth when you want to talk? Stop mumbling. What's such a Nigerian mom? So it's okay. Of course, you know I know. That's
No, good. Yeah.
Investing.
No, no, okay, now, hello. This equation, have you? Now, what I want us to do is to, let's collect like terms. Collect what? Like terms. Like terms.
Comrade, you are living in the person.
Where are you?
In Stockholm, is it in Stockholm?
Okay. Now, what are the like terms here?
Equity and asset.
Asset and what?
Equity.
Liability.
How?
I'm not like them.
They have common factor. What is the common factor? What's the common factor? What's the common factor of asset and liability?
Okay, debit.
They both have A inside.
Debit, debit.
They have a
Debit. That's debit, right?
there's something common then is economic benefit.
That is credit.
No, economic benefit. One is bringing or outflow. One is taking away. You get what I'm saying now?
I agree.
Asset will bring in economic what?
Negative economy.
Liability will take it away. It's now how you manage your asset against your liability that will tell you whether you have something left. Which means if you can't control your liability, therefore work hard to get more. Have you? One of the reasons why many Gen Zs don't want to marry again is the responsibility. Because unfortunately, your other gender in your generation, the demand is very high. And they don't want to come down. They don't want to suffer until this life. They don't want to date 9 to 5.
So workers, they're working. And they're not coping.
Exactly. Therefore, you now focus on your liability to go for something light. That's why you have to pick up. That's why some of you take problem for yourself add the issue from the
Past liabilities.
No, but the question is this: if you can't grow revenue, your focus will be on what? On individual cost. Now, if your salary will not increase for any reason, why are you still ordering all this stuff? Good, I saw that. You should be balancing it with mama put sometimes.
You have to get for the top one.
This Adam.
No, but you are right. Do you get what I'm saying now? Because that's the reality of life. You see that it's common with Europeans, not America. Americans are always American. UK guys, European guys. Find out that today you can see them in central London. Tomorrow they move to Birmingham, Newcastle, and they move back. That's the reality of life. First, everybody wants comfort. Therefore, they focus on the asset to bring more revenue. But if the asset is saying there's no more revenue, yes, you focus on your work. Before you go every Friday, thank God it's Friday. How often do you hear thank God it's Friday? Now, you don't know what some people do. Even big people that have money, not even get. They do house party because it's cheaper. If you go and say, give me a Zoom, 800,000 or I don't know. If you go and buy, it's about 40% or less of what they are selling. Which means if you go and take all this stuff, shortlets, how much will you pay? Probably 200,000 or 150 for a day. And you guys can use the other to buy. You are doing your club.
But there's no hype man now. Like,
they invited me for one long time ago. There's nothing what it's not that they will not do. They will bring side what was this? Side attraction, it says. If you cannot increase your inflow, you must put your out. That's why today many businesses are looking for substitutes. Nigeria before we thought we are resilient, but reality is setting in. How many of you go to supermarkets, stores, and you see everywhere? Even newspaper yesterday published it that Nigeria are now, everybody's now local. Not even about local alternatives.
where you can price.
Even how many of the ladies with Mary Kay again?
Yeah, yeah, one.
If they are dark in color, just use that black one. Because what matter is your endpoint, your equity. Because you must live today to live.
Tomorrow.
Okay, now let's reorder this. Let's collect lifetime. Now we can now take plus liability to the other side. What will it come to? Equity is equal to assets minus liability.
Don't worry.
No.
I believe.
Equity.
Now, the question then is, this equity can now either be positive or what? Negative. And it's a function of if asset is 100 and liability is what? 80. What will be equity? Positive what? 20. If asset is 100, liability is what? 120. What will be equity? Negative 20. Even though your capital might be the same, it means you made more loss than what? Profit. Now, most times you see net assets. And when we say net assets, what I will say?
Assets minus liability.
Net of asset means you have more of assets than what? Liabilities. Therefore, this particular one is net of assets. Why this one is net of liability? Now, how many of you have seen net of liability before? It's rare. Because most companies, before they get to that place, they've wound up. But for some industry, they have. But I won't mention them. Write it down.
Face your phone.
We know.
Face your phone.
Okay. I won't mention name. I'll mention it, but where's the marker? Let me find it for you. On existing policies. In court is a nuisance. It disrupted everything. Tell me, the whole of people you have at Colombia, what would they do? It's only, you can see, and that's why in the Western world, they take it seriously, people they put in power. Because they can turn things upside. That with Trump stuff, many companies have died, and he has revised the policy. Some of them will not come back. Same thing in Nigeria. Many companies die because of government policy somersault. And government will not come and say, yeah, sorry, come back to life. You are gone. Look at most of the people that have foreign exposure that were not hedged. You borrow when dollar was 150. Tell me what you will do when dollar is now 16.
Which one?
10 times. That means you must have made 1,000%. And that's why before you take decision in any organization, you start from the macro economy. Macro, it's more important.
What are they called?
Eh? Component of macro. Okay, let me now. If you can list, there are about 4 or 5. You can list them.
Okay, do we money? Interest.
Interest rate. Eh?
GDP. GDP per capita.
GDP.
FX.
FX.
Foreign reserves.
Foreign stuff. What again? There's no important statistics.
Yeah.
That's
Combustion.
no tax is not. More important one. More important one.
Macro.
Okay. Pick UK, pick US, pick Nigeria. What statistics are rolled out by the Bureau of Statistics anywhere in the world? There's one that we missed. One statistics that always been rolled out.
Employment.
It's also true. Because it also determines whether the economy is growing in terms of disposable wealth. Because all of your analysis boil down to you and I having money to discredit.
But then sometimes unemployment don't give you the best of things, right?
No, it's not only one thing now. Everything is a complex, macroeconomy situation is complex. That's why you build econometrics. What econometrics is just a modeling of economic reality. You understand? Just trying to create an expression of different independent economic variables we have mentioned, how it can now determine economic prosperity of groups.
Everybody.
Eh?
Everybody.
It's possible. Because you know that now, in today's world, we are creating things, you can bring physics and econs together to, because philosophy is the father of every field. Everything was philosophy now before we start to break it down. Therefore, I'm not going to argue whether it's physics, economic physics, or okay, you can start keeping it. Okay. Now, let's go back to by convention. Take note of this. By convention, assets is expected to have a debit balance. By convention, assets you have what? Equity and liability we have what?
Why?
That's why I say by convention. I have an issue, I told you 2 sides, debit and what? We have taken a position to say, okay, male be the head, and female be the what? Okay. Is that not the convention?
Somewhere that was
The family.
Go ahead.
Now, the other side is what we now.
There's no other side.
Okay, there's not, okay.
Okay, we have friends. Friends are better than one.
Yeah, talk. You want to-
I asked the question, I haven't got it.
I'm not a coin now. What is
Now, what we are trying to say is that when you say male and female, the question is to say that where did the name came from. It's just a naming convention. That started with debit and what? Now, we have not taken a side to say, first, asset and liability can never be in the same side. Therefore, if you now say, yeah, you take this position of left, automatically, because you can't be on the same side, this person will take the position of what? Right. That's what I mean by the convention, to say, it has been taken as an accounting convention issue that assets as a debit balance, which means it's on the debit side, not say left. Why equity and what? Liabilities. The opposite of that, which is what?
So it has nothing to do with the giver and receiver theory.
No. We are still coming back to giver. That's transaction based. Okay. Now, why are we saying that? Because asset bother about resources, I mean, but these resources you can only have control over them either by way of equity financing or liability financing. I mean, because remember, equity and liability are doing the same thing. They are to finance the assets, but the finance nature are different. One, you are using your money to finance. The other one, you are using other people's what? Money. But finance is what? That's why those two are always on the same side, because that's where the money in which you use to control the asset came from. Do you get a thing? Or do you get it now? Okay. Equity and liability will be on the same side because they are financing it. Why asset is on the other side? Because that's what you acquire in order to run your world. Now we are not saying that, okay, assets should be debit. Automatically, the other two will be what? Does that make sense? Now, the issue of debit and credit is now a function of impact on assets and impact on liability and what? Equity. You get them. Therefore, we won't be talking of receiver or what? We'll be talking of effect or impact on assets, on liabilities, or what? Equity. Now, these three things that we are responsible for. There are three elements of financial position. There are three what? Elements of financial what? Position. The first one is what? Assets. In this case, I say it's on what? Remember, it's a convention. This convention was, if I were to be look at the pursuit, probably I would have put asset on the credit side. I mean, and if I put asset on credit, what would I do? I'll put liability and equity on the wall. Because they must not be on the same.
Nobody asked him why he did that.
Let me give you. No. Wait, I will. You know, there are some answers that I will not give now because you may not appreciate it until you are exposed to further things. When you now give that answer, you now say, okay, I'll come back to the original answer. But I'll give you an analogy or something that is real. How many of you know about Solomon? Social media. Oh, do you know? Yes. One day, they like whining that man. But that man so intelligent, and sometimes he goes haywire, but he knows what he says sometimes. Somebody now asked that over Solomon. Maybe you'll be, you know, that man is a pastor and everything. he needs everything together. He does the thing. Now, they now ask the guy that in the Bible, when the Israelites were running from Egypt, Moses laid the stick, and the Red Sea parted. And I said, wait to Obasolo. Should they say ocean does not have end? Therefore, how come the same thing that doesn't have end was parted into two? And two, not the ocean. Where did they not get the who filled you know, there are some questions you don't ask. You know, because they will tell you when I was growing up, they say there are something, you know, sometimes something comes from mind and say, okay, who played God? You know, you know, the guy that said, you know what, that if you go and ask the surveyor, there are some things that doesn't have answer to. But again, as at then, the Italian monk only came with the concept that there are two sides to every transaction. Now, to not name it right side and left side is what he named debit and what? Credit. Do you get what I'm saying now? Because again, I cannot ask, who named this one right? Who named this one left? It's just people agree to say, okay, so there are two. Let us take this one to be right and take this one to be what? Yes. Do you get it now? Now, this is the left-hand side, asset, which is debit. The right-hand side is what? Equity. And what? Liabilities. Because there are only two sides. There are only what? Two sides. First side and what? Second side. Only that two things fall under one side. Because this is economic resource. And these two are what? If this is economic resource, what are these two? And I'm going to give something tangible now. If you have watched those videos, you know what it is. If asset is economic resource, what is equity and liability? If you want that, it's not giving less.
Users of economic.
No. No, if you get it, I'll give you some. This one is a chat. Eh? Tip.
Give the economic generator, something like that.
Economic obligation. Yes. I wanted to farm. But let me not give you another one. Okay. This one, yes, is a claim over what? And this one is the claim over what?
Claim over economic resource. Claim over.
If you can get it.
Claim over asset.
Which one?
Equity.
Liability is claim over what? They are getting it. Equity is what? And therefore, it's claim over what? Capital. Don't. Okay, claim over what?
Come and give him something. Have you?
$800. That's why you find that if you want to settle liability, you first of all gather on the asset. No limit, gather on asset to settle what? Equity holder only have claim if there's something left. If there's nothing left, they walk away. That's why they are risk what? Takers. When you buy shares, if you read all the prospectus and everything, it's there. You are taking risk. It's there, you put the money there. It's prayer. That should be. Do you get it now? But debt holder, they still have rest of mind to say, maybe the company asset is still there. If working for what? And that's why here, now look at it. Look at it. Hello?
Yes, sir.
The person that I asked debit credit. If we have agreed that asset is what? Debit is a convention, have we? Any further debit to it, will it increase it or reduce it?
Increase it.
Which means if you have to vote for me, and I'm here, and this guy, stand here. There are two people, have you? This is debit, this is credit, have you? If you decide to queue here, what are you doing? I'm adding to my report, have you?
Yes.
But if you decide to go to this side, what are you doing? You are reducing my report. Which means if we all agree that asset is a debit, asset will only increase if what? Debit it the money. But it will reduce when what? Credit. That's the effect. Which means if cash is an asset and you have debit, I mean, the more cash you get again, what happens?
Yes, sir.
It increases, I mean, but the cash you spend, what happens? Liability is on the credit, I mean. When you credit the money, what are you doing? When you credit debit, what are you doing? What about the equity?
Credit increase. Yes, credit.
Credit is also credit, but equity is also credit.
Yeah.
When you credit equity, what are you doing? When you debit, what are you doing? Therefore, which means if you do a transaction, you ask yourself, what impact does it have? What are the accounts involved? It creates an asset. It creates a liability. Is that asset increasing? Or is it what? Reducing? Is that liability what? Increasing? Or is it what? Reducing? But you see it in a typical way. Have you shared the material? Okay. Now, there are two other ones that I've not mentioned. Yeah. We have elements of financial performance. And what are the two? What are the two? Income. And what? Expense. Now, somebody expect me to say revenue. Okay, can you say revenue and income are the same?
No.
Are they the same?
No.
Why? Are they the same? Why are they not the same?
I don't know if there is small when you answer the question, like waiting for
Revenue.
directly.
Okay, let me show you like this. Revenue is made up of, income is made up of revenue and other income or gains. Income is the totality of the gross inflow associated with your increase in assets or decrease in what? Liability. But revenue is simply a portion of income attributable to your principal activity, which is your core income. Your core source of what? Income. Which means Asami Synergy revenue is its core, and it is from selling of what? Products. All income from sales of LPG, loops, AGO, ATK, PMS, and the like is revenue. But that's not only source of what? Income to establishment. Who can tell me another source of income to establishment?
FX.
FX income? No, throughput is part of revenue because he owns those depots. It's part of the activity. Therefore, throughput should be part of the revenue. Only that it's not product revenue. Service revenue.
Rental.
Interest income. Rental what?
MFR.
What other income?
MFR.
Disposal scrap of assets. Probably has investment in one company. Dividend what? Income. Any income that is not associated with this principal activity. Other income. Okay. Also, we can break our expenses down further into various forms. What are they? The first kind of expense that is critical is what? Cost of goods. Cost of goods what? Tools, or what we call cost of what? Services. What is cost of sales? The cost of sales is your expense that are directly attributable to generate that income, that revenue. They must be directly what? Attributable. That's why product cost and any other incidental cost that without it you can't sell are part of your cost of what? Now we have other one. Other one are what we call operating what?
Expenses.
This is where you have your day-to-day administrative what? Expenses. And you can also have other losses, which are considered other what? Expenses. A loss is an expense, as a gain is what? An income. A loss is what?
An expense.
If you lose products, through theft, through damages, through spillage, is an expense because it constitutes an outflow. It's not until you spend money before you get expense. You can see now. Okay. Now again, look at this. Also, income has a credit balance. And we can explain this. And expense has what? A debit what? Balance. Income has what? A credit balance. Expense has what? That's why also here we are saying that the income will increase if you credit the income. And your income will reduce if you do what? Debit. Your expense what? Will increase when you debit it. And your expense what? Will reduce when you what? The question is credit or debit depends on where are you standing. And where you are standing, is that transaction coming to meet you there or meeting you at the opposite direction? If it's coming to stand with you, it's adding to you. If it's standing against you, it's doing what? It's deducting from. That's why if you vote for somebody against another person, what you are simply doing is you are deducting from the vote of the person you did not vote for. Not necessarily you are increasing the vote of the other person. Do you understand that? Which means if 5 people vote for me and 4 people vote for the other person, net is only one person that's the unique vote that makes me win. And that's why if you follow, how many of us follow US election? Now, what is always the focus of US election if you want to win?
Electoral.
No, not electoral college is a framework.
That's like the primaries.
No, not the primary.
the states in between, like they have
Swing state.
It's swing states. That's what matter in election. That's why you see that you don't campaign rigorously in your stronghold. It's a stupid person that will stay in stronghold and campaign. Even without campaigning, they will vote for you. You go for where you have people that they are dicey. There are 3 places you vote and you campaign. You campaign in your stronghold, in the stronghold of your opponents, and in the street. Where you put more of your energy is the street. Let me tell you something. There are some places that if you go, if you like, kill yourself. Say, I will. There's nothing that will make the president go shout it and say, I must win this. What they would need is give me votes that at least will make me meet that 25%. It will be a deceit to say, President, don't worry, you win in Anambra. It's not possible. It is not what? Possible. But what you can promise the president that you know that you are saying the truth is, I will ensure that at least you get 25 what? %. Which is reasonable. Which is what? It's like you want to contest now, an article you contest, not saying you go to Adamawa to beat that. It's possible if you are in Northern. But you are from Lagos, you want to yeah. What I just need in Adamawa is 25 what? %.
What's that doing in Lagos?
No, Lagos is not a territory of anybody. Do the okay, is Lagos State, will you say Lagos State by population or by anything is a Yoruba state?
It should happen. They are indigenous, so by
How many indigenous? Indigenous of Lagos State are now up to 5%.
because they've been washed away.
They are not washed away.
Because
No, they are not washed away. Listen. The population, Lagos State, according to census, is about 24 million now. The Lagos indigenous are now up to 4 million. Therefore, how are they washed away?
I don't know, they migrated or something.
They didn't migrate.
They were not.
Because it's a small, it is because of the immigration into Lagos that expanded Lagos. If you want to go to the history, the whole of this place, was swamp now. Surulere that you are seeing today, the entire of Surulere was swamp. That's the area you are saying. Do you get what I'm saying now? It is because of people coming, and feeling expansion and scope. It was a small hub now, very small hub. And the first set of people that developed Lagos, where are they from? Portuguese. No, I'm not talking of the shores. I'm talking of the mainland. No, they are warrior, but that the mainland there, where Yeshomolu, Bagada, K2, and who are they? They are the Jebus. Because that is the central hub for trading. You can see. Just it. Therefore, it's not about Lagos is in quote is a land for.
So I have a question.
Yeah.
To come to Nigeria and then develop Nigeria. Does that make Nigeria a man's land?
A no man's land.
No, nobody says no man's land though. Don't make it. In Dubai, UAE population is about 6 million. The total population, the whole of UAE, is it 6 or check? But you find out that people like you and I are even the most populated that place, and that's why they are there. No, this is total population with external people. Check 10.4. That's why when you go to Saudi, you go to Dubai, they made it such that you can't, no matter the money you have, you can't buy land.
1 million. 1.1 million.
1.1 million. And most of them are central in Dubai. But you can't buy land there. Is to protect that heritage. But that's what we didn't do in Lagos. They even sold their own heritage because the money was free that he did not finish.
Right.
Okay, now let's start the work for the day. We are taking time to do this because of the implication. Now let's go back to what I've shared. Wanted to now we'll start to see account implications of every step we take in an organization. Okay, I was trying to give 10 minutes break. Let's have 10 minutes break. Thank you. I'm worried. Now, look at this. You'll find out that I put up exercises. We pick a typical company that just started small in year one, ABC Limited. And this was the transaction they did in year one. Process this transaction, understand the implication, draw up their financial position, their financial performance, and see how we produce the same accounts that we have. We'll now look at the activity scaled up in year two, scaled up further in what? Year four, and the like. Okay, but before we do that, I'm going to share something with you. And we need to pay more attention there. It's going to lead us to the next level.
Hi, I'm Ned, a financial analyst with several years of experience in one of the big four accounting firms.
Well, that's going to be the highest for it.
No.
Hi, I'm Ned, a financial analyst with several years of experience in one of the big four accounting firms. I very much enjoy teaching and would love to share my expertise with you. So I welcome you to this accounting course in which we will learn about bookkeeping, credits and debits, the main income statement and balance sheet items, and how to construct an actual P&L and balance sheet. The exercise that we'll carry out together will show you how to register accounting transactions and build complete financial statements. We'll go step by step with nothing skipped. We will then introduce the concept of cash flows and the importance of their timing. Very often, business owners learn the hard way that profit does not equal cash in the bank. In the third part of the course, we will analyze the financials of one of the largest companies in the world, P&G. We'll learn the main financial ratios that are used in financial statement analysis, and then we'll calculate these ratios in order to provide a real-world example. As you can see, we have lots of work ahead of us. So, dive straight in, and let's begin this journey together. Hi. In this first lesson, we'll try to answer three main questions. What is accounting? Why do we need it? And what types of accounting are there? I'm sure you'll agree with me that these are three important questions we should ask at the beginning of the course. So, let's answer the first one. What is accounting? Accounting is an information science that is used to collect and organize financial data for organizations and individuals. Okay, perfect. Let's break down this definition. First of all, we said that accounting is an information science. It is concerned with analyzing, collecting, and organizing information. But what type of information? Accounting organizes financial information. It is about money. It is quantitative in nature and measures money. Accounting isn't an abstract science. It is much more practical than theoretical. It's one of those things that you'll learn best by doing. The last part of the definition says that accounting serves organizations and individuals. How come? Well, as one can imagine, every firm needs to be able to organize the financial information related to its business. A firm has to know how much of a product it was able to sell, how much it cost to produce the product, and how much money it has in the bank. Similarly, an individual needs to be aware of their personal finances. If they don't pay attention to how much comes in and how much goes out, they may soon be in deep trouble. I think we've answered the second question too. Accounting is a science that helps us organize and represent financial information, and it helps corporations and individuals understand their finances and make decisions about the future. Accounting helps you to use the past in order to take action in the present and change the future. Pretty cool, right? However, there is one more question that we need to answer. What types of accounting are there? There are 4 main areas of accounting. First of all, we have bookkeeping. Without bookkeeping, we wouldn't be able to do anything, because bookkeepers are responsible for all of the information that is collected and taken into consideration. Bookkeeping is a fundamental activity, as it ensures that financial information has been gathered systematically. Then we have financial accounting, which focuses on the 3 main statements: income statement, balance sheet, and cash flow. It is prepared for the company's ownership, its lenders, financial analysts, and for other external stakeholders. It is highly regulated given that the information is prepared for third-party users, and they should be able to read it without having inside information. The fact that the information is prepared according to a specific set of rules renders it comparable with the one prepared by other companies, which in turn facilitates investors and lenders. Financial statements are prepared according to a uniform set of rules called accounting principles. The aim of these reports is to allow externals, like banks and investors, to get an idea of your business. How much sales you had? Was the company profitable? How was it financed? And so on. The third type of accounting is managerial accounting. It is available only for insiders. It is not defined by accounting principles and is in most cases more detailed than financial accounting. It contains strategic information that shouldn't be seen by the firm's competitors. Managerial accounting looks into topics like pricing, competition, marginality, budgeting, and so on. The company does not want to reveal this information to outsiders because, well, otherwise outsiders will prepare a counterplan and gain strategic advantage. Of course, managerial and financial accounting are often interrelated, and it is a frequent practice to reconcile managerial and financial accounting figures. The fourth type of accounting that we need to mention is tax accounting. This is the accounting that will determine the amount of taxes that a company has to pay. Tax accounting is a very technical field that varies for every single legislation in the world. We won't cover it in this course. In this course, our main focus will be on bookkeeping and financial accounting, as they are the solid foundation that one needs in order to understand financial transactions.
A warm welcome to 365 Careers YouTube channel. We are really excited you're watching this video. Our mission is to create some of the best business, finance, and office productivity tutorials and deliver them to you right here. Our channel is updated on a weekly basis, so make sure you click the subscribe button below and stay in the loop for interesting and career-enhancing video tutorials.
Bookkeeping. Here is where it all starts, the collection of information. In order to be able to appreciate its importance, try to imagine for a second that tomorrow you wake up and all the bookkeeping records in the world are gone. The first thing that you find out is that you don't have any electricity at home. The electricity company shut it down because they didn't have any records of you paying the bill. That's an awful surprise, right? But wait, there's more. You decide to go to the nearest supermarket and buy some juice, butter, and bread. But when you get there, they tell you that they don't have any. They didn't know that they were out of stock because all of their bookkeeping records are gone. You're starving and you don't have any electricity at home. Miserable situation. Perhaps some shopping in the city center would cheer you up. You decide to withdraw some money from the nearest bank. But when you get there, you find out that the bank doesn't have a record containing your name. They've lost the information about your savings. They are gone. You get the point, right? Modern society as we know it simply cannot function without bookkeeping. Bookkeeping is fundamental for corporations, banks, investment funds, and even individuals. Let's provide another example. Think about GE, the General Electric Company. GE has over 300,000 employees, and it operates in more than 170 countries in the world. The company operates in business sectors like appliances and lighting, aviation, financial services, energy management, healthcare, oil and gas, power and water, and transportation. Can you imagine how complex its operations are? Is GE going to be able to monitor its businesses without a proper bookkeeping system in place? Is it going to be able to understand whether its operations in a given country are profitable or not? Or whether there is a product that is not profitable and should be discontinued? Recording every single transaction that takes place within the firm is paramount at this level of complexity. It is proper bookkeeping that ensures that all necessary information has been recorded and is ready to use. I am sure that you get the point. Bookkeeping is the cornerstone around which all accounting is constructed. Okay, so in our previous video, we talked about bookkeeping and why it is important. Here, we'll focus on financial accounting, the set of financial reports that a company prepares for people that are outside the organization. Such reports enable outsiders to gain an understanding of the company's business, about how many sales the company made this year, about how many sales the company had last year, and they also show how profitable the company's business was and what kind of costs it sustained. In addition to that, financial accounting reports show what a company owns and what it owes. They show how much cash was available in the company's bank accounts at the time of preparation of the report, and so on. We can conclude that financial accounting allows people who are outside an organization to make a reasonable judgment about its business. And why is this important? Why should a company go through all the trouble in order to prepare such reports? Think about the opposite situation. What if the company did not provide financial information? What would have been different in that case? Is there a bank that would be willing to lend money without knowing how you are going to repay the loan? Is there an investor who would be willing to put up their money without knowing anything about the financials of the company's business? The answer is no. And that's why companies prepare their financial reports. It enables them to communicate their financial performance to those who are interested. Think about General Electric. It's a huge company, right? In 2014, their revenues were north of $148 billion. And being a public company, they have thousands of investors who are located not only in the United States, but all over the world. Their investors are in France, Germany, UK, Japan, everywhere. And how is it that they monitor the company's business and decide whether they would like to hold their shares or sell? They use the company's financial reports. They analyze the company's financial statements and all of the details that are necessary in order to understand the company's business. I'm sure that you understand just how crucial a role financial accounting plays in today's financial system. Without financial reporting as we know it, most businesses would have been denied the capital that they need. Financial accounting revolves around three main statements: the income statement, also known as profit and loss, or simply P&L, the balance sheet, and the cash flow statement. Each one serves a different purpose and contains important information about how a business is running. The income statement answers the question, how did the company perform throughout the period under consideration? Did it produce a profit or a loss? Typically, an income statement is prepared for a one-year period, but sometimes larger companies present it on a quarterly basis as well. The P&L statement helps us understand whether the operations of the firm created economic value. It also enables us to find important trends such as revenue growth and the incidence of gross profit on revenues. The balance sheet answers the questions, what does a company owe and own on a certain date? And what is the company's financial position? It shows the assets that the business controls, the liabilities that it owes, and the amount of equity that belongs to equity holders. The reason why it is called a balance sheet is because total assets must equal liabilities plus shareholders' equity. It is important to remember that assets stand on the left side of the balance sheet, while liabilities and shareholders' equity are on the right side. The statement of cash flows answers the question, how much cash did the company make during the period under consideration, and where did it come from? Given that income and cash generation are two different things, we need a statement that shows us the movements of cash, providing an idea of the liquidity that is generated by the firm's operations. You will find these statements in every company's annual report. Anyone who would like to get an idea about a given business should start here. In this lesson, we will talk about the main income statement items that a firm will register throughout its business cycle. We have to start with revenue, also known as net sales. This item represents an inflow of economic resources. Usually, the main type of revenue for a given firm are its day-to-day sales, customers buying goods that the firm sells. There can be other sources of revenue as well. Companies can and do make money outside their core operations. For example, they can earn money by renting some of their real estate or by selling goods that they do not typically sell. The account that unites these sources of additional revenue is called other revenue. Okay, so this is the top line of the income statement. This is how the firm makes money. The sum of net sales and other revenue equals total revenue. Let's provide a practical example. Think of a dairy company. It produces milk and cheese and then sells it to chains of supermarkets. When the company sells milk and cheese on a daily basis, it registers sales, right? Its clients, the supermarket chains, have to pay for the goods that they have received. This is the firm's core business, and the amount of sales that the firm makes will be registered as net sales. At the same time, the company also rents out a real estate property that it owns and receives rental income for it. It will be registered as other revenue because this activity is not part of the core business of the firm. Such distinction is necessary because it allows us to separate sales coming from core business activities from income that is a result of non-core activities. And as we said before, the sum of net sales and other revenue equals total revenue. Below total revenue will be listed the firm's expenses, outflows of economic resources. In order to fuel its sales and produce the goods that it delivers to clients, the firm needs to sustain certain costs. The most common types of expenses are cost of goods sold, selling, general and administrative costs, depreciation and amortization, and interest expenses. Cost of goods sold are expenses that are necessary to produce the goods that the firm sells. Our dairy company needs to buy raw milk from local producers, transport, process, and then package it before it can sell it to the large supermarket chains. It sustains additional costs in order to produce cheese from the milk. All of the expenses that are directly attributable to the production of goods that are later sold are registered as cost of goods sold. The difference between total revenues and cost of goods sold is called gross profit. This is the profit a company makes after deducting the costs associated with making and selling its products. Selling, general, and administrative expenses are a large category of costs. The dairy company classifies here its expenses for advertising and promotions, salaries of its management and personnel that is not directly involved with production, accounting, office, and auxiliary personnel, rent for its offices, and utility bills such as electricity, phone, and water bills. Depreciation and amortization are two accounts that reflect the using up of tangible and intangible assets. Depreciation refers to assets of a physical nature, while amortization is the term that is used for intangible assets, goodwill, licenses, copyrights, etc. Every year, the plants that the dairy company owns become 1 year older, and therefore their value is reduced. In order to account for such reduction, the company registers a depreciation expense. Interest expenses are the costs that a company bears for receiving financing. Typically, firms receive bank loans and pay interest expenses for the amounts they owe. The dairy company, from our example, had to ask for a bank loan when it acquired a new milk processing system. The bank agreed to lend the necessary funds at an interest rate of 6%. Every year, the firm has to pay an interest expense on the amount that it still owes. Such interest expense is registered in the company's income statement. And finally, we have taxes. There are two things that no person can avoid, and one of them is paying taxes. Every firm pays corporate taxes that are proportional to the amount of pre-tax profit that it generated. The rules according to which the amount of pre-tax income generated by the firm is measured may vary depending on the country where the company operates. Once all expenses are considered, we arrive at the bottom line, which is called net income. This is the excess of revenues over expenses, the profitability of a venture after accounting for all costs. These are the typical items that you will find on an income statement. Later on in the course, we will go through a complete case study and show you how the items are registered and organized in order to form a complete statement. This will do for now. Thanks for watching. As we have said before, a balance sheet is a statement that shows what the company owns and owes. Every balance sheet has two sides. On one side are the company's assets, what the company owns, and on the other side are the company's liabilities and equity, what the company owes. It is important to remember that assets stand on the left and liabilities and equity are on the right side. In this lesson, we will describe the main asset, liability, and equity accounts. Our goal is to understand how these accounts contribute to the company's business cycle and the nature of the items that these accounts describe. Let's start on the assets side. The cash account is one of the most important drivers for a business. It shows how much of the firm's assets are cash or can easily be converted into cash. It gives us an idea of the liquidity of the company. We know very well that a business cannot function properly if sufficient cash is not available for its day-to-day operations. The next important item that we will see on the asset side is accounts receivable, also known as trade receivables. When customers buy a firm's products, they have to pay for them, right? And until they do, the firm will register this amount in accounts receivable, which indicates the money owed by customers. The firm registers that it has earned a payment from these customers, but has not yet received the payment. Inventory is the account that shows the value of raw materials, goods that are in the process of elaboration, and finished goods that are ready to be sold to customers. The company has all of these goods in its warehouse. Finished goods are products that can be immediately shipped to customers, while raw materials and work-in-progress goods require additional processing. Property, plant, and equipment are a group of assets that are vital to business operations. Imagine a production company. It certainly needs plants and equipment in order to transform raw materials into finished products. Usually, this is a hefty investment that cannot be easily liquidated. The value of property, plant, and equipment is reduced each year, or should we say depreciated, in order to account for the fact that the asset will be obsolete after its useful economic life ends. These are some of the main types of assets that we will see in financial statements. Let's focus our attention on the liability side. Accounts payable are certainly one of the most important items on the liability side. When a company buys raw materials for its production process, it registers the amount in accounts payable until the actual payment has been made. The firm owes its supplier a given amount of money because it received the goods. Financial liabilities are a significant item for a lot of businesses out there. A financial liability appears on the balance sheet of a company when it receives external financing, which is usually a bank loan. The firm uses the funds in order to finance its operations and commits to repaying its lender in the future. On the same side of liabilities stand the ownership claims, such as paid-in capital. This is the firm's capital that it technically owes to its owners. This capital would not be repaid to the shareholders, but the company will try to pay them a decent amount of dividends if its business is successful. These are some of the most frequently seen balance sheet items. I am sure that after this lesson, you'll have a better idea of their meaning. We are always open for any questions that you might have, so if you would like to ask something, please don't be shy and post your questions in the discussion board. In our next lesson, we will go a step further, introducing the main accounting equation. Hi, welcome back. This is 365 Careers Accounting course. So, we've learned what accounting is and why it is useful, the 4 types of accounting, the 3 main financial statements, and also some details about the accounts that form each of these statements. You should feel pretty good about the progress that we are making. So, now is the time to look at the main accounting equation. Do you remember what a balance sheet is? I'm sure you do. A balance sheet shows what a company owns and owes at a specific point in time. On the left side are the company's assets, the things that it owns. On the right side are the company's liabilities and equity, showing how the company was financed. This is what the balance sheet portrays. The reason it is called a balance sheet is because assets must equal liabilities and equity. The 2 sides have to be equal, or else a mistake has been made. This principle is known as the accounting equation and is one of the core principles around which accounting has been built. Assets are equal to liabilities and equity. This is very logical, right? On the right side, we have liabilities and equity, which are the firm's sources of financing. Liabilities are other people's money, and equity is our money. On the left side, we have the firm's assets, the things that it has bought with the money that it received. Given that we are thinking about the same amount of money on both sides, it is only natural that one side is equal to the other. The accounting equation must be satisfied for every business you will ever see. It balances for the gelato shop on the next corner, as well as for Walmart and Chevron.
Sorry.
Okay. We'll do this before we go to break. I want to go back from break. We'll go back to our main question that will allow us to process transactions, generate a balance, and draw up a financial what? Statements. We'll do all that before today ends. But let me just show you again as a snapshot our financial statement. Now, principles you find in a financial statement like this, you don't need to, it's just for you to, you are not writing an exam, it's just for you to have understanding of how to read a financial statement. Now, there is a standard, generally global, that prescribes what you will see. And that's why when you pick financial statement of Sahara, you pick that of Chevron, Seplat, they look as if they are the same. It's like we are copying ourselves. What is only different there is numbers, I mean, and some other is because there's a standard that provides minimum line items to be presented in the financial statement. Okay, and later on we are going to discuss what is the component of financial statement. When you say you owe RAC financial statement, what is the minimum thing you must find there that is the same with any other big corporation? We'll see that. Also, in most financial statements, you find out that in the balance sheet, assets and liabilities are classified as correct and what? Non-correct. Okay, and I will explain. But there's an exception to that. Go back to RAC. Pick 2020. Page 28. You find that in the asset section, you see that it's divided into two. Non-current assets and what? Current assets. What does that mean? The word current is defined by time. And the time is 12 months. Which means any asset to which you believe you will realize the benefits from that year end to the next year end, the next 12 months calendar period, as classified as what? Current. Okay. Any asset, you know, you said asset is economic resource that will bring economic benefit. Now, if any assets will give the economic benefit within the next 12 months from your reporting what? Date is current asset. Which means 12 months is a benchmark. No, it's not value. It's not value. It's just based on when we like get benefits. You see benefit I'll get within 12 months. If it's yes, it is correct. If it's no, it's going to get it done 12 months. Therefore, it is non-correct. Correct. Now,
So
next 12 months.
what if the benefits exceed?
Yeah, that's what I'm saying. Now, anything that's more than 12 months is what? Non-correct. Now, okay, speak loud to me. He said, what's the inventory? Now, look at it here. What are the things you find in current here? What are inventory? No, outstanding goods.
Someone actually have a question. What if you sell what if you sell your property, like your building, in like a 12-month plan? That means you realize the money.
No, we are coming to what is inventory? Inventory is your item in your normal course of business that you either produce or buy to what? Sell. And we're going to come back to it that an item might serve as inventory in your book, but it's something else in another person's book.
I have a question. If I have a bakery, if I have a bakery, so where would I classify my flour? Is it in inventory?
It's inventory. Now, hello, inventory are outstanding stocks. Are closing what? Stocks. And inventory can be decomposed into 3 or into 4. Who can decompose inventory into 3 or 4? We'll even discuss it in
Finished goods.
finished goods. Raw materials. Work in progress. That is the one that is inside the machine. You know, as at the year end, there are still some things inside production process because it's a robotic stuff, I mean. That's work in process. And we also have consumables and spare what? Parts, small, minor spare parts. But to some companies, inventory is just goods. Which means, like Sahara, you buy and sell. You are not processing everything. But for companies like Guinness, Nestle, the inventory is a combination of raw materials that has not been used, raw materials that's already been processed but has not finished as at that period, raw material that has been fully processed and finished but has not been what? Stored. That's it. And any other consumables.
So how am I valuing it? Is it by the value or at the price I bought it?
Okay, we'll come to valuation later. Okay, take note. We come to when we get to other aspects, we come to valuation. Okay, that's that. Again, you see things like receivable. What are receivables? What are receivables? Receivables are your collections, that is money that are due from your customers, not your debtors, your customers. We don't, before we always call it debtors, we'll call it receivable. The difference is that it looks somehow when you want to describe a person and say it's my debtor. You know, intuitively, you see debtor as somebody owing something that has furnished you and yet well. That's why we now use things like receivable. But those holding days we use debtor.
What is the payment is now overdue?
You cannot call him a debtor then. But we still call it receivable. The only thing that we cannot classify it as a doubtful receivable or a lost receivable. A bad what? Yes. Like, now you also have cash and cash pay. Cash is money you have in your teeth. Not somebody that always come to play with some finance people because they have petty cash, but you do know that you can't have access to that petty cash. I know that person we are looking at our but cash also in the bank is cash. And anything that can be converted into cash without any liquidity risk and within a very short period of time, I will consider cash equity. And we have prepayments. This prepayment we're talking about is when you have to pay something that's no more than 1 year. You have to be payment for 2 years, and you have this 1 year remaining what? or you even deposit money for something that they are yet to deliver, or service yet to be what? Okay, but all of those ones always fall in 12 months. But there are some that falls above 12 months. For example, your PPE, property, plant and what? PPE now, the company that owns it is expected to use it for 40, 50 years. It is not current. It's what? Non-current. When you have some investments, like investment in First Bank and also federal government bond of 10 years, these are non-current. Because the benefit will flow over more than what? 12 months. When you have,
What if we bought this build, like we sell the building? We're going to realize the money in between 12 months.
when you have a building, you are not a real estate that is willing to sell or buy.
But you said the owner of the building.
You are not getting it. This building, what was the intention of building this building or owning it by the owner?
Office.
It's to
Utilize.
utilize this over a period of time.
So we didn't buy the building.
We didn't
Buy the building.
we bought it.
Exactly.
For what?
But like what the people that sold it, let's say like Sahara built it, right? And then they sold it to another company. We realized the money within 12 months.
And you know, that's why we are coming somewhere. Sahara business is not to buy and sell building. We bought this building because we want to use it for administrative work purposes.
But we bought it from someone. The person, how would they record
And
this?
keep that person first. Let us talk about our own. You understand? Now we can now take the position of that person. Sahara now, in the books of Sahara, you put this building as non-current assets because this is a building that will serve you benefit for more than 1 year. You can say now, we can go as much of 40, 50, and go. Now, let's now go back to the person that sold this building. In the person who before selling this building, what do you believe it will be?
No current.
It depends.
It depends.
Now,
There's more of current.
I will tell you something that what is inventory to you might be PPE to another person. The people that sold this Tuesday, I can tell you that it is inventory to them. Because they are this level, they build and sell. You understand? Therefore, you know, real estate also have different ammo. There's real estate that is to generate revenue and capital appreciation. That one would you treat it as PPE or investment or property. But there are some real estate that they only build to sell, whether off plan, after plan, or whatever plan it is. Therefore, those ones will take building as inventory. Inventory is something that is repetitive, is recycled. Which is that's what you do from the day to day. You build to sell, you build to sell, you build to sell. It's inventory.
So, sir, let's stay with the inventory in
Yeah.
the conversation. You've said that it's something that should be within 12 months.
No, not all inventory again. I'll give an exception. Most 99% of the time, inventory cycle is shorter than 12 months. But there are some specialized inventory that you can find that is more than what? 12 months. One of them is real estate development. Depending on if it's bungalow, it is not 6 months, 2 months. If it's high-rise, take 2 years, 3 years. Aeroplane inventory will take as much as 3 years. Boeing and everything, sometimes I'm trying to buy jet now. Because if you are buying jet from a used jet, that's when you don't really have bad. If you are buying a brand new jet, you subscribe. They don't produce jets, you understand, it's subscribe, it's okay. And it could take a period of 2 years.
Or 3.
Or 3. You can say now. And therefore, Boeing to Airbus is inventory.
So it's not prepayment.
No. To them, we are talking of them.
Like if we put in our order.
No, it's prepayment. It's inventory. They are the one producing.
But if we pay, is it still inventory?
It can be inventory because where's it?
No, like to them.
Oh, they've collected the money now.
It can't be inventory.
No, it's still inventory because it's inventory until you deliver it. What you pay, they will treat it as customers' deposits, which is a contract liability.
It's not their own. When you pay, right?
You only deposit now, you stop taking custody.
The item has not even been produced.
Even if you have been produced, you are not taking custody. Okay, let me give you an example of Ashari. There are some customers that deposit to Ashari.
Yes.
When they deposit to you, and you have not given them the goods, it's still inventory your goods, have you?
Yes.
Like I don't know how to explain it. It is not like a liability system or something.
Yeah,
Paid for.
Paid debt is what called contract liability. It's a liability to them because the customer has given them money, but they've not delivered to the customer. That one is contract liability. But the company still have the inventory with them.
So they'll still record the thing on inventory.
Of course.
So have you sold inventory?
No, it's when you say it disappears. It's not like inventory.
But they've already sold it, they just not delivered it.
What is sold?
The contract is not in.
The title must have passed before you say there's sales.
So the title doesn't pass when you give them money.
No.
You may not have finished paying now.
Even if you are finished paying, you only pay. Okay, remember Nigerian Buhari deposited for Tokano 600. And we paid 3 years or 4 years before delivery.
I don't think you understand my question.
Because land with your question.
So, like Asharon synergy now, if a customer has made order and then they've given me the money before I land the product.
They're giving Ashami the money?
Yes, they've given Asharon the money before I land the product. So when the product comes and it sits in my tank waiting for them to offload, I can't record that product as my inventory as a company. Asharon synergy.
Ashami synergy has the product itself. Don't mix it up. Use this man as an example. It's a customer that came to you. You are Ashami synergy. And this person deposits with you. Is that correct? Is that what you're saying? Okay, what are you saying?
Let's say he's selling a bottle, right?
Who's selling a bottle?
He's selling the bottle.
Okay.
And then I've come to him. I know he sells bottles, and I'm his customer.
Who are you? Are you the Ashami now?
He's the Asharon.
She's the Ashami.
Yeah.
Okay. Yeah.
And I've paid, like I've given him.
You pay this person, yes?
Yes. So
You've not collected.
I've not collected the product,
Yes.
right? And then the product comes and it sits in his books. Will he record that product as inventory?
It's inventory.
Because the risk is running. If anything,
What is inventory?
Inventory is done. I don't know how to.
Inventory is the goods of yours that is still your custody.
Still inventory.
But
But he will also record your payment as a liability.
As a liability, because
But he
if
has
tomorrow,
to
if you
get
can't deliver the goods,
that's double recording.
there are two separate transactions, it's not double recording. Don't worry.
By the time you collect your product, the liability will now become an asset, as either cash or whatever it is. And then the inventory will now.
The cost of sales. Don't worry, you see how everything. That's why you see that accounting is a process. You take it one by one. The money you gave this man is a liability in his book, not revenue yet, because he has not given you that item. Therefore, you will treat it as contract liability. But you still have custody of the inventory until you deliver the inventory to you. Because what is inventory again? It's goods that is in your custody, that is yet to be delivered to you. And it can be in a raw form, it can be in a finished form, it can be in a semi-processed form. Sorry.
Another scenario, right? Typically, you pay money for electricity. When you use you pay them that you're paying, let's say you pay now, and then you've not gotten that electricity. So that electricity, what's I supposed to record it as?
Okay. Now, from the IE perspective, when you pay, it goes into a customer account as a contract liability, similar to telecoms. It is when you consume that it deducts portion of it and take it to revenue.
It's like a middle waiting area.
Yeah?
It's like the money has a waiting area.
Yes, now. What happens? That's why there's a difference between collection analysis and revenue.
People saw the difference.
Yeah. Deferred revenue is what we call liability because it is going to end up becoming revenue only when you have delivered. But for now, customer has paid, but you have not delivered. Do you understand? That's why people like I cannot do it manually. That's why you have a system. It's your system that is doing that. It's not finance people that will calculate. How many customer bills? About 800 something. Are you now 1 million? 1 point something. Who will sit down with? It's your machine that will say, okay, he has consumed this unit. You just take from your deferred revenue or your contract liability and take it to revenue. Is it manual? I don't think so. If it's manual, they won't do it per customer one by one. They'll just do it in aggregation. But they should have a manual now. System will make it perfect, like the telecom.
Like the telecoms.
Yeah. It's the same thing. Business of IE and telecom is the same thing.
Understood. Understood. So the telecoms would keep your money, so they won't call your money that you've paid them revenue until you finish using it.
Yes, or until it expires.
Okay.
You know, for example, your data may expire, your credit may expire.
Yeah.
Once it's expired, you have lost your rights. They just wipe it to revenue straight.
There's a lot of accounting things because for Blue, when it has expired, they take it away. But when I recharge again, they roll over.
No. What happens is this. In that case, they are not going, if in that case, they are going to warehouse. You know, there are 2 levels usually. For example, I do monthly subscription 30 days for MTN. After 30 days, whatever is there that you didn't use is suspended. They will not tell you that once you renew, they add it back. In that case, they are not going to take it into income. But there's it doesn't go back.
So they will not check everything if
It's machine, it's computer, it's program.
just like
It's program, you don't need to. Okay, you thought it's a staff that is adding it back.
no, I get it, but I'm just like the lot of
It's machine. That's
So that money, you call this contract liability.
any money you receive from customers to which you have not delivered to customers is a contract liability.
Okay, so now, fine.
No.
So I wanted to ask, like the data, whatever, the broadband that they have left to their customers, they will still call that thing like an inventory. What if they sell it by, like, what if they sell it?
Okay. The question is not everybody that have inventory. A service company barely have inventory. If you are not selling.
What if Assurance Synergy sells the product in their tank when somebody else has paid for it?
Like what?
If you call it inventory, like the mindset would be to like sell the goods in inventory. No, I'm asking you, like you said, services don't have inventory. So I'm bringing it back to Assurance Synergy. Like I want, like if they, because they recorded it as inventory and then somebody says, oh, like what do we have in tank? And then they say, oh, this because it's recorded as inventory and they sell it. Somebody else has already.
Inventory also have more encumbrance. You can see that it's inventory, but it's meant for somebody. It's not available to any other person.
But I still don't understand why we would group it as the same thing when they have these different financial obligations and implications.
No. The item itself is inventory because the control still resides with you.
I've not left your
Issue of money is secondary. That's why you take that as liability. The question is, if attorney cannot deliver the product to that person, what would be the worst thing that will have happened? If someone says, give me back my money, have you? Yes.
And you still have.
And that's why you have put it as contract liability. You have no business with inventory. Don't worry, we'll get there.
So how will you now balance if if something happens to the goods when you've already paid for it, then I give you back the money? So that extra amount of money I'm paying.
There's no extra.
It's money. I'm just refunding you, except your contract.
And they can't give back.
Yes, so the loss,
Your 10 million. It's not a loss.
the loss is inventory.
There's no loss.
Okay, no,
Okay, sure.
if you already done the product, like the aeroplane now, you already created it, then you now had fault or an issue, and you now.
I'll just reduce my inventory. And what happens on the other side? Yes, what happens in the other side? How do I balance it?
Other side.
Credit and.
Okay, no worry, we see it.
If we lost, you do what?
It's not an expense now.
So that means you should know, if you cannot sell it, then don't call it inventory, right?
No.
The inventory has nothing to do with selling or not.
Wait. First, what is inventory? Inventory is unsold goods. Does the good exist?
But
Yes.
they've already sold it, they've just not delivered it. No.
That's what it's not deliver now until you perform the obligation. What's the performance obligation? Delivery. How can I tell you sold something and the car is still in your it's not sold it.
Have you ever had a situation where you ordered something from like a clothes store and they told you that the clothes is out of stock and they had to give you back?
No,
that means
because they
that's
usually tell you, like, I don't know how to explain it. Like the way I see it in my head is that like when you say something is inventory, that means it's available for sale.
Okay, let me give you
Like your raw materials or like work in progress or finished products that is in that you can turn to money.
Yes.
What you
Okay, so maybe just look at it like this. It is still available for sale. Because you can actually give it to somebody else. So maybe look at it, that's why it's a prepayment, right? Maybe look at it as a loan or somebody borrowing money. If I've sold the goods to you, but I still have it in stock, can I give it to Olamide? I can't.
Yes.
Right? Because it's still with me. I can't decide to give your money back.
Yes.
I can decide to give it to anybody here, which is why it's inventory, because it is still within your control. By the time you hand it over to somebody else, it's outside of your control. So don't look at it as just because you've given him the money, then the goods are automatically yours. There are instances where somebody will run away with your money. Instances where somebody will say, oh, I'm so sorry, I can no longer deliver something to you. So it's with you, it's your good. All you've done is you've collected a loan I don't want to use loan, but you've taken repayment for that.
I'll give you a shocker now. Imagine you deposit for a car. And they're about to deliver the car, probably the fire accident.
or the tank enter water.
Now, what will you say? Would they say they've sold it to you?
Yeah, but that depends on type of contract, right? For cars like that. Like if it's an FOB contract, if immediately it leaves your port, like the responsibility and risk now lies with me, then that's
Hey, that's what we're
They sold it to you as
It means what's that cross?
equal terms is just
Don't worry,
part of the
we're going to see people can't practice the last thing. And that is majorly international commercial plan. You understand? The question, okay, I'll give you a practical example. 2 weeks ago, we ordered car from
GMT
Stallion. From Stallion Motors. And they brought the car here to us. But we observed something. We didn't know that that was the model. Even they that did not know, because our fleet discovered that when you do something, this one on, I think it's like a design, but nobody knew. They just felt okay. They now took it back.
All the cars.
No, one. It's not a dirty car. They took the car back to the office here. This before environment there. They took it back, and our fleet guy joined them. When they now got into the premises, they also discovered that all other models, the same model there, They are
They have the same thing.
and I think they may call it said, no, it's a design or something like that. No, when you see something you thought it's different. Now, unfortunately, listen to me. Hello. Unfortunately, this guy was driving the car.
I'm thinking.
And a Prado ran into the car. And take notes. Car was coming out of the. It's like half outside, half inside. Half inside. Inside. But the accident happened outside. Now, it was a disaster that day. And what I told my people is that, and it was on Friday.
And we've not gotten insurance for the vehicle.
No, it hasn't gotten. Have you even registered the car? Now, the question then is, have they delivered the car?
Have they?
And I said, no, they've not.
They've not.
No.
Unfortunately, it's our own driver that drove. But the question is, delivery is to my office, and there must be a discharge.
Yeah, and GRN.
Now, you know what? And that's one of the reasons why I said we have gotten a level that we don't deal with vendors of all the small. We deal with probably the distributor, the OEM, or the main dealer. Now, what happened? Immediately I constructed an email. And the first thing was that to identify that there was ugly incidents. And that so. But please kindly note that this car was supposed to be delivered to the over the weekend. But these ugly incidents have probably shifted it that please, since there are alternative ones there, if you can make it available to us on Monday so that we can meet the requirement. The Oegoman or what is it called now responded that sorry for the ugly scare and everything that we will ensure that by Monday get
Interesting.
But that would not have happened if it's all this roadside dealer. They would have blocked you. The problem is that it is our driver. But they are seeing the car. But the driver also want to use opportunity to drive from there to here to see the function. You can see now.
How much did they send the driver?
It's not somebody ran into a Prado, from the back. It's not what. But the question is that it was still inventory because contract not passed.
That's not the fact. Yeah.
That's why we talk about as the local risk and reward transfer. No. And that's why there is a penalty for that.
It's not small. It's not small. It's not small.
Because no, there's no issue. We are not saying that if it's a Nigerian, typical Nigerian thing, don't you have come.
Yeah. That I'm already giving you the car.
You have that a big car.
In his own head, he say, I'm not going to be your driver. Just it's kind of Nigerian.
No, if you have a reputation, go on. You know that, hello, you know that a good car seller or dealer will have in-transit insurance. You know, there's insurance for your warehouse, there's also in-transit.
Yeah.
Yeah, you cover it. But again, the person that caused the accident also have there's principle of subrogation where the insurance company of the person want to.
Okay. So what is
Now, cash.
Are they detecting private now?
So what if the incident happens at we've not signed that we've received?
This happen,
That happens here.
that's why you need to define when has time to pass. When and what?
Time to pass.
That's why for international trade, that's why there's international benchmark, which you call Infocams.
Jesus.
It will tell you, is it FO? Is it everything?
So which one do you call liability? Like, what do you call
Liability is what you owe and have obligation to take.
No. But delivery at place, it would be
Payment,
still.
liability.
No, prepayment is from the angle of the person that paid, which is an asset.
So if the person is receiving payment, what would the person receiving it called?
That's
Contract
why
liability.
that somebody.
That is liability from a contract between me and my customer that I have not yet executed or delivered.
All right.
It makes sense now.
Yes, it does.
Written, signed, sealed.
Okay, look up, please. Now, please look up so that you can go on break and ensure you eat light because the main stuff will be break to 4. And we are not going to joke about, and there's going to be an assessment. The 5th year, you will take it home and you bring it tomorrow.
Which people there?
There's traffic.
I'm giving you a demo there now. Everything today.
Of the what? Adam.
Yes, hello.
Adam.
Now, where? Hello. Current and what? Not current. You do that for assets, you do that for liabilities. But there's exception to the rule. I'll give you an assignment or task. Generate financial statement for GTB and Zenith for 2024. It's already in public. You can go to their website, download it, and see whether they show it in current and non-current. You will not find it. Why? Because current and non-current classification or subgrouping is premised on the fact that your order of presentation is permanent. It's order of permanence. That is, you find out that in the financial statement, you find out that things that will take longer time in grant first, things that will take lesser time, rank what? Last. If you go to non-current assets, PPE always comes first because PPE will live long. That's why in America they call it long-lived assets. They barely call it PPE. Followed by things like investments, intangible assets, right of use assets, like that. Similarly, inventory takes longer period than receivable. Because inventory, if customers are not coming to buy, they are not coming to buy. But receivable is time passage. It has a time. Every day is getting closer. Cash is already at. Does that make sense? Okay. Any question? Okay. Now for banks, they don't do that. They present in order of liquidity. And liquidity means that what comes first is most liquid item. What comes last is what? Less liquid what? Item. Now also, in financial statements, sometimes you can create a unique line if that transaction is so material that you need to report it for people to have better understanding or appreciation.
Okay.
Also, financial statements must be presented fairly so that it depicts the financial position, the financial performance, and the cash flow of the entity. And this was what formed the premise of our financial statement. You will see what the components are. Okay, and also in accounting, in prepared financial statement, we make some assumptions and judgments. One of the critical assumptions that underline what you do in financial statement is that the company we are preparing this account is a going concern. Because if it's no longer a going concern, the financial statement will be slightly different. And I'll show you this same rank. I'll give you a financial statement where we wound it up. And you see that it's slightly different from this one. I'll give one copy each. Okay, so that I can see that. Okay, we also make judgments and assumptions. And we're going to see most of them in the financial statement. But again, how does it look? This is the component of financial statement. There are 5 components of financial statement. The balance sheet, which is the statement of financial position. The income statements, tier 1 and 2, which is statement of profit or loss, and what? Other comprehensive what? Income. Statement of changes in what? Equity. Remember, we said equity is the residual. It's what is left of it, which can be positive or what? Negative. And increase over time or reduce over time. Now, we need to provide a reconciliation so that people can understand what is increasing the equity and what is increasing the equity. That's the objective. And this one is very key. Statement of cash flow. Why? Everything in our financial reporting system, our financial statements are based on the principle of accrual. Principle of what? Accrual. Except for the statement of cash flow. And that's why you find out that profit and cash are not the same for the same company. You see company that is profitable, but they say cash no day. How possible? It's because I make income even when I've not received cash. Because the accrual principles recognizes income only when it is earned and not when it is what? Received. And it recognizes expense when it is what? Incurred and not when it is what? What does that mean? If I sell goods to somebody and the person will pay me in 3 months' time, today I've already recognized profit. Unfortunately, probably we have done some profit, we have paid bonus on profit. The customer now, we learn that is bankrupt. And that's why some people always want to say, I'm not interested in profit. I'll mention somebody. You all know the person. That's he has no accounting standard called TAS. Who can tell me? What's the account standard? TAS. If you get it, I'll give you something. Eh? Who? I'm saying accounting standard. Yes, something accounting standard. What is standard now? And what is T? It shows you your sources of cash generation and your sources of cash what? Utilization. And also show you pattern and also narrow it down to your activity level. There are 3 main activities that every organization conducts its business through. Operating activity, which is your core. Investing activity, which is where you more or less put resources to be able to guarantee your continuous production, sustainability. And investing financing activity, which is the major source of finance or funding, whether internal or owner or external borrowing. And this thing is not always more than 4 pages.
Pages.
Yes. 1 page, 1 page, 1 page, 1 page. Maximum, this one can be 2 pages. I witness maximum 4 to 5 pages. But anything can be numbered. I can generate financial statement for you and just put number there. And it will make sense to you if you are just doing analysis without understanding what it is. But for you to understand the financial treatment of any company, this is where you get the fact. Note the what? Now, let me give an example. You know, we read something about right of use assets. In the balance sheet, you just saw a number. It doesn't say anything. But when you read, you saw a lot of information. Now, revenue, go to page 20. Go to page 28, 27. 2020. Revenue for 2020 was 1.4 billion. What does it say? 1.4 billion. And then? No, before the time, what is 1.4 billion? The maximum thing you can say that, okay, it reduced from 2019, have you?
Yeah, reducing it.
Okay. Well, you can say more. And this is a oil marketing company. Therefore, let us now go to note 5. Note 5. Note 5 should be on
Page 50.
page 50, have you?
Yeah.
Page 49.
49 and 50.
Okay, can somebody read that one?
Amy.
Read note 5.
Wow.
Yeah.
Demi.
Revenue. Yeah. Continue.
Revenue from 8 June, December 2020, 1.084 billion. Revenue from 8 June, December 2019, 3.5 billion. Revenue from PMS, 302 million. Revenue from 2020, revenue from PMS 2019, 806.9 million. Revenue from DPK, 20.3 million. About December 2019, 49.4 million. Revenue from Loops 0 as of December 2020, as of December 2019, 37.234. At the end of which we have 1.408 billion as of revenue for 2020. And for 2019, we have 4.42 billion. So a significant 5.1. A significant portion of the company's revenue is sold through a related company, Sahara PLC, a subsisting Sahara Group oil and gas downstream entity, which by court approved scheme of external restructuring have now subsumed the operations and businesses of the defunct Soul Energy Limited. The company had an agreement with Soul Energy, which was by court sanctions moved to Astronomic PLC to wherein Astronomic PLC procures products and sells to customers with a 5% commission on the charges on the margins made on such assigned sales. Whereas Astronomic Energy PLC funded the operation of such sales and operated as an unlisted agent, the agreement effectively transferred the risk and reward of the transaction to Rock Unity Petroleum Company Limited, Program PLC, was with recourse of collections back to Assurance Energy PLC where applicable. The sales made under the agreement and recognized the revenue of Rock Unity Petroleum Company PLC are shown in the lines below together with the associated costs. Known to the financial statement. 5. Revenue continued. For sales made by Assurance Energy under agency agreement, 750.461 million 2020, 2.31 billion 2019. Sales made by RAP to third parties, 67.6 million 2020, 2.1 billion 2019. Total of 1.408 billion for 2020, 1.419 billion for 2019. Total. Cost of sales for sales made by Assurance Energy PLC other agency agreement 702.562 million 2020, 2.25 billion 2019. Cost of sales for sales made by RAP to third parties 615.7 million 2020, 1.993 billion 2019. Making a total of 1.32 2020, 4.219 2019.
Now, you could see all detail, you cannot know little of it. But before you also, is that how you make decision? You just see number and say, I want you to know. You don't know about the activity. Part of the activity, you know it through the notes to the what? Financial statement. And it has a format. General information about the reporting entity. Now, let's go to the notes. The first note is note 1. What page is that? That's page 31. What did you see? General information about the reporting what? Entity. Can somebody read that?
RAP Unity Petroleum Company PLC was incorporated in Nigeria under the Companies and Allied Matters Act as a private limited liability company on 20th December 1982 and converted to a public company on the 16th of November 1987, 5 years later. The company is domiciled in Nigeria and the address of its registered office is Block 5 Ijora GRA beside Lagos State Water Corporation, Ijora, Lagos. The principal activities of the company are to carry on the business of petroleum sales, marketing, store oils, petrol, gas, kerosene, filling stations, erect structures for that purpose. The company deals in retail and public supply of petroleum products.
It is critical to know the business of the company you are trying to analyze or invest or anything. You can't just say, I want to invest. You must know who you are dealing with. Even your customer want to know who you are. Your vendors want to know who you are. Your bankers want to know who you are. Government want to know who you are. What next is that you must issue a statement of compliance with what? IFRS. IFRS is one of the standards used in accounting. Different countries have standard, but globally now we now have a unique standard. But not all financial statements are prepared with this standard. That's why you must state which standard it is, so that you know how to interpret the financial world statement. Okay, now look at note 1.2. Okay. Yeah. Look at note 1.4. Look at note 1.4.
Okay.
The financial statement have been prepared in accordance with the International Financial Reporting Standards, IFRS, as issued by the International Accounting Standards Board, IAS.
Another thing you do is to provide basis of preparation of financial statement. Now look at the basis here. 1.5. Just read the first 2 paragraphs.
The company prepares its financial statements in accordance with the International Financial Reporting Standards, IFRS, as issued by the International Accounting Standards Board, IAS. The financial statements have not been prepared on a going concern basis, as the directors have decided to dissolve the operation and business of the company through a voluntary winding up within the next 24 months from the reporting date. All values are rounded up to the nearest thousand, except when otherwise indicated. The financial statements are presented in thousands of naira.
Read the subparagraph.
The financial statements have been prepared on a historical cost basis, except for those that may be measured at fair value, present value, or other basis of measurement, as may be disclosed in the accounting policies for individual assets, liabilities, transactions, and events. The financial statements are presented in Nigerian naira, and all values are rounded to the nearest thousand, except when otherwise indicated.
If you are now, people are aware that you are presenting this account in thousands. Because when you go to the account, you are seeing 1 million, but it's in billion. Have you? Okay. Now, also, you disclose some kind of accounting policies. Accounting policies are what underpin the preparation of accounts. That is where the bulk of the work of accountants are, the technical aspect. And in this case, you disclose all of the accounting policies. Now, if you go to note, can you see note 3? Significant accounting what? Policies. You are not going to disclose hundreds of your policies, but to disclose the significant one. Now, in that one, you can see that the first disclosure is about revenue what? Recognition. But yeah, read that revenue so that that madam will know when you recognize revenue. Read 3.1.
The company derives its revenue from contracts with customers for transfer of goods and services over time and at a point in time in the major product line, which includes sales of petroleum products and provision of space for retail stations. This is consistent with the revenue information that is disclosed for each reportable segment under IFRS 8 operating segment. Revenue from contracts with customers is recognized based on the application of a principle-based 5-step model of IFRS 15, which is as follows. Step 1, identifying the contract. Step 2, identifying performance obligations. Step 3, determining the transaction price. Step 4, allocating the transaction price to performance obligations. And step 5, recognize revenue when each performance obligation is satisfied.
Now let's now look at the major one that's source of revenue to RAC, sale of goods.
Revenue from sale of goods is recognized when the significant risks and rewards of ownership of the goods have been passed to the buyer, usually on delivery of the goods, including the company has transferred to the buyer the significant risks and rewards of ownership of the good. The company retains neither continuing managerial involvement to the degree usually associated with ownership nor effective control over the goods sold. The amount of revenue can be measured reliably. It's probable that the economic benefit associated with the transaction will flow to the company. The cost incurred or to be incurred in respect of the transaction can be measured reliably. Revenue is measured at the fair value of the consideration received or receivable, excluding discounts, value-added taxes, excise duties, and similar levies. The company assesses its revenue arrangements against specific criteria in order to determine if it is acting as principal or agent. The company has concluded that it is acting as a principal in all of its revenue arrangements.
Now, which means, how many of you have worked in investment banking before? Okay. Yeah, in investment banking, before you focus on number, especially if you have got a certain level, what you analyze much more are the disclosures and everything to extract. That's even where you get more fact about your equity analysis that you publish, as a sell side. Is that not? It's not just number. Number is not enough. I can randomly on Excel generate financial statement that will you just be doing analysis paralysis on it and there's nothing back in it. Do you guys hear that? Okay. Also, you talk about critical assumption, estimation, and judgments. Let's go to a note that talks about judgments the board of RAC made over time. Go to note 4, which is on page 48. So yeah, investment banker, you should read down. Note 4, page 48.
Critical accounting judgment can place sources of estimation uncertainty in the application of the company's accounting policy, which are described in the directors of the companies are required to make judgment, estimates, and assumptions about the carrying amount of assets and liabilities that are not readily apparent from other assets. The estimates and assumptions are based on historical experience and other factors that are considered to be relevant. Actual results may differ from these estimates. The estimates and underlying assumptions are reviewed on ongoing basis. Revision to accounting estimates are recognized in the period in which the estimate is devised. If the revision affects only that period, or in the period of revision and for the future period, if the revision affects both current and future periods.
4.1.
Critical judgments in applying accounting policy. The following are critical judgments that the directors have made in the process of applying the company's accounting policy, and that they have most significant effect on the amount recognized in the financial statements. The first one is on revenue recognition. The company has an agreement with related parties to conduct this on its behalf. The related parties will product and sell to the customers. Payment for those sales are equally received by the related party. As a consideration, the related party receive 5% commission on the margin made on such sales. Management views the arrangement as agency relationship with the company as the principal and the related party as agent. This judgment is based on the following considerations. 1. The agreement transfer all risk and reward of the transaction to the company. 2. The related party does not recognize revenue on the sales made under this arrangement in its own book. It only recognizes 5% gross margin as other income in its own book. Third one, as ceramics NGPS displays on the face of invoices issued to the customer that is an agent of the company. Next point, the VAT taxation and recovery of the VAT tax asset, which entails the company's inability to recover its tax credits because there are no regulation or provision in Nigeria to carry backward on utilized tax losses and unutilized capital allowance upon cessation of business. 4.2. Key sources of estimation and uncertainty. The following are the key assumptions concerning the features and other key sources of estimation uncertainty at the end of the reporting period that have a significant risk of causing a material adjustment to the carrying amount of assets and liability within the next financial year. First one, impairment of assets. Determining whether assets are impaired require an estimate of the value in use of the cash generating unit to which assets have been allocated. The value in calculation requires the company to estimate future cash flow expected to arrive from the cash generating unit at a suitable discount rate in order to calculate the present value. The assets were assessed for impairment and there was no indication of impairment observed. Therefore, no impairment loss was recorded during the year. 4.2. Key sources of estimation uncertainty continue. Useful life of property, plant and equipment. The companies review the estimated useful life of property, plants and equipment at the end of each reporting period. During the current year, the directors determined that the useful life of items of equipment should be the same as previously impairment of trade and other receivables. The company makes allowance for doubtful debt based on assessment of the recoverability of receivables. Allowance are applied to receivables where events of changes in circumstances indicate that the carrying amount may not be recoverable. Management specifically analyze historical bad debt, customer concentration, customer credit worthiness, current economic trend, and changes in customer payment plan when making a judgment to assess the provision for doubtful debt. Where the expectation is different from the original estimate, such difference will impact the current value of the receivables.
Yeah. Also, we now have explanatory words, notes, and relevant disclosure. From note 5 is now where you have the breakdown of revenue. What is the breakdown and notes? You have 6, cost of sales, have you? You have 7, segment what? Information. You have 8. 8 is employee what? Cost. And the range of staff and salary. 9, directors emolument. No, that's 8. 9, administrative and management what? Expenses. What we always call before now, general expenses, general admin and selling expenses. We also have the loss for the year or profit for the year. How do you analyze it? Other income, income taxes, how you analyze it, deferred taxes, earnings per share, PPE, the breakdown of the PPE. You have trade receivables, age analysis of the receivables, repayments, cash and cash equivalent, how much you have in bank, how much you have in hand. You have right of use assets that we discussed with the money. You have issue share capital. You have your retained earnings movement. You have your trade payables. You have your related party disclosures. Okay. You have your financial risk management disclosures and the like. You can say that. And that is it. And remember, financial risk management disclosure and capital management was If you pick any company, you see the same pattern. Only that the debt will differ depending on how complex your operation is. Okay, any question? So that we'll go on break.
I have a question.
I will come back to 30. Yeah.
Most likely, when companies are recognizing bonus, based performance bonus, they put on that direct or indirect
Performance bonus to
their workers.
SaaS.
Yes.
How will it go to? It will go to directors. Director, they just want
No, direct costs.
Oh, no, it will go to your admin cost personnel. Look at it now. You will see something there.
Staff cost or expenses.
Go to staff cost here. You know, under your admin cost, you see staff cost, have you?
Yes.
Under that staff cost, you see breakdown of staff cost somewhere. Depending on if you want to break it down, where is it? Was it broken down here? No.
Just a bandit.
The bandits, you understand? They carry your employment costs in so benefits. Sometimes, you know, these are not statutory information you disclose. And if it's statutory, you also disclose it. But it's going to be part of your personnel.
And under indirect.
They are not talking of direct or indirect. They are talking
No, I'm
of
just asking.
cost of sales.
Yeah.
They are talking of admin expenses.
So shouldn't it be under my cost of sales?
No, they are not factory workers. These are stuff you pay. Whether it's your personnel cost that goes to cost of sales must be directly traceable to production. But here they are not producing. They are only buying and selling.
No, I'm asking from the point of view.
Company.
Yes, or even if it's sales.
Now,
no,
it doesn't go to that. Cost of sales are costs incidental to producing to sell. For example, in upstream now, if you have normal staff that you pay, whether production goes up or not, those ones goes under administrative expenses. But if it's staff that are based on production that they only go to produce, if they don't produce, they go back at home to go and sit down and you pay them based on what they contribute. Those ones will be part of cost of production, cost of sales. When we look at it, when probably we look at it whether direct cost, indirect cost. Is it directly attributable or is it indirectly what attributable? Okay, we'll come back in 30 minutes. And we are at the critical stage whereby if you are able to appreciate this, which I know you will have a better understanding of financial accounting issues, at least as a non-accountant. Okay. Now the fourth exercise is how a company that has just started a business, a newly incorporated company, how they build up the account for the first year. And as you expect, second year they are growing. Third year they've got to a certain level. And each of those years, you are trying to introduce additional layers of principles. But by the time we get to year 5, we have demonstrated all understanding of the principles. And we can be rest assured that if taking something vital out, that every one of us here will now understand accounting, basic accounting principles. We can read, understand, and finally analyze financial statements, which is critical. We can also engage in discussion on transactions, all because you will now understand implications of every step. Yes. In this case now, we'll be switching between PDF exercise documents and our Excel worksheets. Okay, just take note that,
It's confirmed that you all have the worksheets.
yeah, but you don't need to open the worksheet at your own end. Just focus on the screen that we shared in terms of, whatever we are doing here, we jointly do it, and I'm going to give you what we are jointly doing. Just leave me to help you input, but you will tell me what to do. Is that okay? Now, I will take time to read this question. The question reads thus for year one, which is ABC Limited started a business on 1st of January 2017 with a capital contribution of 1 million naira in cash at the bank to the company by its what? Shareholders. Now, what does that mean? We need to interpret that. That means we just start up a business, have we? And every business requires capital to start up. Now, this capital has been provided by way of money the shareholders have deposited in the bank. And we have said earlier, dated back from Lucas Pacioli WNT, is for every transaction, there are two sides of it. Yeah. There's a side which we could call debit. There's a side we call what? Credit. Well, we should debit or credit. We don't know yet, have we? But we will now interpret this transaction to identify the two sides that are involved. Now, in this case, if we narrow it down, what do you believe are the two sides to this transaction? Equity and assets, okay? When you say equity, which form of equity? And when you say asset, which form of what? Assets. Now we have seen that equity has components, have we? Asset has components, have we? Liability has what? Components. Now we'll be much more interested in the composition, the class, the item, not just assets. Do you get what I'm saying? In this case now, what component of equity is affected? What component of what? Assets is affected?
Which assets?
No, not that. I'm talking of the item. Is it cash? Is it inventory? Is it receivable? Okay, cash is one item, have you? Okay. What's the other items?
You don't commodify the high.
Oh, that's capital. Yeah, capital. Is it? Okay. Therefore, those are the two items. Are we getting it right? Hello?
Yes, sir.
Now, if that is the case, let me switch to my Excel. Now, we'll build this template. Look at it, please. Let's pay attention. Hello? Now, we have built this template. The first year is in Chile. 2017. Let me change it. Okay, look at it. This company, as at the beginning of the year, had nothing. Yes. But the company is just incorporated. Okay, now, but we are familiar with things that are common in terms of equity. The two lowest level of equity components are share capital and what? Maintenance. For assets, at least we have cash and bank, have we? Yeah. We have inventory. We have what? Receivables. We have what? Property, plant and equipment. We have prepayment, have we? But there are much that, have we? Yeah. But we assume that probably this is the spectrum we have. Under liabilities, We said we have what? Payable.
Tax payable.
That's normal account payable.
Yeah.
We have tax payable. We have what?
Balance loan.
Under income. We only have revenue, have it?
Yeah.
Maybe we don't have other income. Other expenses, what do we have?
Cost of sales.
Cost of sales,
Salaries and wages. Rent and other expenses. Depreciation.
Amortized facility management fee, finance costs, and what? Taxes. Now, let's go back to the question. ABC Limited started a business on 1st of January 2017 with a capital contribution of 1 million naira in cash at the bank to the company by share what? Yes. Now, 1 million naira is the value of that transaction. Therefore, I will now ask you, since you have identified capital and you have identified cash as the two sides to the coin, have you? Now, a company's cash position, will it increase or improve, given that they've injected 1 million naira into that company? It will what? Increase. What about the share capital? Will it increase or reduce? Increase. Now, which means what we'll be talking about here is increase or decrease as an impact on those items. We will be talking of debit or what? Yes. Therefore, you come here and say, introduction of capital injection with what? Cash. What is the impact? The impact of my share capital is increased, I mean, by how much? 1 million. The second leg is cash, I mean. What is the impact? Is it increase or reduction? Increase. By how much? 1 million. We process the transaction. I can't say we've debited and we've got. I don't use that. Let us just look at the impact. Is it increasing? Is it what? Now let's look at the second line of transaction. In the year, that is 2017, the company purchased 10,000 units of items, have you? 100 naira per month, and they did that on cash. That means they don't have payables, but they have the cash to pay. Now, how do we analyze that transaction? It means they took out of the cash, bring in inventory. What will happen? Cash will do what? Reduce. Inventory what? Will increase. Because they are not bringing stock in to their warehouse. Therefore, what do we do? Take note of 10,000 and 100 naira. We will now recognize purchase of what? Goods. We don't say purchase of inventory, because we always characterize inventory as unsold goods. That is goods we purchase that we are unable to what? To therefore, we purchase goods, 10,000 units at what? 100 naira. That costs us how much? 1 million. Which means the entire cash of 1 million. Use it to buy goods. Therefore, what do we do? My cash will do what? Reduce. By what? 100 naira times what? 10,000. That's good. That good minus? That's good minus. Have you? Yeah. What will happen to inventory? I'll come to inventory and do what? Plus, have you? 100 times what? 10,000. Now, if you look at my balance, what can you see? It's now between inventory and what? Share capital. Cash that came in will disappear. Does that make sense? Which means every step you take has implication. And you can always intuitively know the implication. And that's why you see that most times when some of us accountants or finance people are talking with you, we are processing that stuff. That's why sometimes I say, I know it's not possible. Somebody just like, what's this guy saying? Why is it not possible? Because I've already put 1 to 2 of the implication. I cannot say that no, if this is what you want to do, this is the implication. Therefore, let us do it in this way. Now let's go back again. Purchase those goods. What happened? We start to look for customers. What then happened? They sold all the units. At what rate? Average. During the what? Now the question you now have to say that did you sell on credit or did you sell on what? Cash.
On credit.
How do you know it's on credit?
Because there is a balance of 900.
Yeah, because look at an expression that says as at the year end, only now as the what? Collected. Which means if you do cash and carry, you won't be saying only now they are collected. That means that our sales is on what? Credit. Let us deal with that first. Which means when you sell on credit, what happens? You earn revenue. Which means your revenue will increase a bit. And start to create receivables, which also what? Increase. Now come up and say, sale of what? Of goods. 10,000 units because we sold all. At how much? 120. Now let me now add on credit. On what? Custom. Therefore, what will I do? Where's my revenue? It's under income, I mean? Yeah. This is my revenue. Did it increase? Yes. I'll say plus what? 120 times what? 10,000. What also affected? Receivable. I mean, receivable do what? Increase by what? 120 times what? 10,000. Now you can see the impact now. I've earned income, but I've not collected 1 naira. Have you? Now, when you earn income through revenue, there's a cost to it.
I think it's not meant to be 100K.
Eh?
No, it's not meant to be 100K that you give me.
100?
100K.
I can't drink it how.
Like, you know, they said the what is left is 900K from your.
No, really.
No.
How much did you sell?
Okay.
For 120. You sold 10,000 units at 120. That's 1.2 billion.
No, sorry, I'm talking about what you showed us before in the question, like the 900K.
Yes, we are not talking there. That is at the end of the year. We are by that end of the year.
You're adding the money that we owe as part of receivable.
They are not owing.
No. I'm sorry that they owe us as part of receivable that we've not collected.
They are not collected as at now. You just sold today.
By the end of the year that
we have collected only now. We are coming to collection. We are still today. We are still accounting for what we have sold on creditors. You get what I'm saying?
I was just asking because we call the receivables.
Hey, what is receivable? We have not collected money. When we sold to customer, we sold on credit.
So receivable is cash plus credit.
It's what?
Cash plus credit.
Tax.
Cash, like what?
No, receivable total amount customers are owing you. So we sell on cash.
On credit. Right. That's receivable for me.
Sorry, I'm so sorry. I thought that what we record in receivables would be the difference between the.
No, first. But first of all, you call the total sales you made on credit before you now apply money they paid
by the end of the year. Still opening balance.
Step by step.
Okay.
At least you recognize sales first. And see before you recognize payments. You get it? Don't lump it up, you see it clearly. Now, when you sell, there's a cost to you sell.
Mhm.
The whole of 120 million is not income that you now go and spend. Remember, you bought a product that you sold for 1 million. Therefore, you need to match the cost of that product to it, which is the cost of what? Sales. Therefore, what will I do? I will now have to recognize my cost of what? Sales. I will release my cost from my inventory. You know, when you sell, what happens to your inventory? Goes on. And by accounting, it will go off from inventory account to cost of sales what? Account. From assets to what? Expense.
When you sell, inventory goes down.
Yes. That's why I said goes up. Not up. Now, how will you treat inventory now? What happened to your inventory? It will reduce, I mean. Therefore, we come here, reduce by what? By the value of that goods, I mean. How much did you buy the goods before?
1 million.
Not 1 million, 100 naira.
100 naira.
Power. Okay, for 1 million. Don't do it globally, 100. And how many did you sell? Entire, I mean. And now come here and say inventory will reduce. That is minus. By what? 100 times what? 10,000. What does that mean? It means there's nothing in inventory again. Because everything that came in by purchase are entirely what? Sold. And what will now be my cost of sales? Will my cost of sales increase or reduce? It increase. By how much? 100 times what? 10,000. That's what?
1 million.
Does that make sense?
No, it doesn't make sense.
Your inventory reduce. Your expense what? Will increase. Because you have to incur that 1 million to be able to sell at 1.2.
But you've already subtracted it before.
No, I subtracted inventory. Inventory will go off. Once you hand over the goods to the customer, what will happen to your inventory? Because that's why it's negative. It decreases, I mean.
Yeah.
What will happen to your cost of sales? It increases. Because you are saying 1.2 million naira that I earn as revenue, it costs me how much? 1 million. That's when you can now match your revenue and cost of it and say you make gross profit of what? 200,000. If you have question, ask. Now, the revenue we made will now pursue the customer. We pursue who? The customer. What do they say about the customer?
At the end of the year.
After all our pursuits, we have only collected how much? 900. For whatever revenue. Which then means that what will happen? My cash will increase by how much? 900. My receivable will reduce. Therefore, I'll come here.
I don't understand. Please, why are your receivables reducing by 900?
I said you are owing me 1.2 and you are not giving me 900. Will you still be owing me 1.2?
I don't understand.
You said customer is owing you 1.2.
But that's not what you called it before. You called it revenue. Like,
is it not revenue and receivable? Look at it now.
It's receivables that are collected.
but that's what I was saying before. You now said no, we've not gotten there.
Look at it. Madam, wait. Look at it here. Look at your, let me fold in it for you. Let me put it in green. What did you see here?
It's the same thing for some sales of goods.
What happened to your revenue? It increased. And what happened to your revenue? It increased.
So why are you saying now that the receivables will reduce?
Receivable means customer has not yet paid you the 1.2. Now, customer has now given you 900,000. What will happen to the balance of your customer? Will he still be owing you 1.2 when he has given you cash of 900?
Sorry, I don't understand. Again, I'm so sorry.
You back. Let me try to explain.
So you sold on credit. When you're selling on credit, you're supposed to affect your revenue. Your revenue will grow up to recognize sale. Because it's on credit, you then have to also increase a column or a place called receivables. If I see your revenue and your receivables, I can easily see, okay, you sold, earned 1 million, 1.2 million, but you sold on credit. That is why you have 1.2 million in your receivables.
Instead of
Do you
having it
understand
in
that?
cash, you have it in receivable.
Do you understand that? I sold on credit. I did not get cash, but my goods left my shop. So I recognize 1.2 million in my P&L as revenue. Then I will then go to my receivables account and credit that same 1.2, meaning that I have sold, but I don't have the money yet.
Okay.
When you now pay me, whatever amount you pay me, I now have to go to that receivables. Because receivable says, oh, Chimere is owing me 1.2 million. Now she has paid me 100K. She is no longer owing me 1.2, but 1.1. So you see the 1.2 initial entry.
Receivables is cash.
It's not cash.
Okay.
Somebody owing you money.
Receivable is an acknowledgement that your customer is owing. It's a customer's account, something that's able to see.
Yeah, which is why I was confused when he increased it by 1.2 in the beginning. That's why I thought you would put the difference between 1.2 and 900.
So you put 1.2.
Start from one place now.
Now that they have paid, you will now put a negative 900. You say, oh, but this person was owing me 1.2 before. Now the person has paid 900. That is why a negative is coming. You then have a difference of 300. So your balance is 300. That means you're owing me.
Remember that
300.
every transaction you process it immediately.
Entry. Okay.
Last week was when you made the sales. You passed the entry. Payment has not come. It's today that payment is coming. You apply it, or you just wait. You won't process the transaction. The customer will pay. So that you can net it off. No. Transactions are processed on a continuous basis. Daily, you process your transaction so that you can know your true position. Okay, imagine customer has not paid. They now say, okay, show us your customer's balances. What will you say? You say, sorry, we have not posted. You must post transaction to reflect the reality as at that point. Okay. Now, since we have collected 900,000, what are the two entries affected? Receivable and what? Cash. Is cash increasing?
Yes.
Because the customer is paying more. And receivable is increasing? Because you're not selling more, you're even collecting money. What will happen? Your customer indebtedness is going down because you are collecting what? Cash. What will I do? I'm going to do what? I'm going to debit. Okay, I don't want to use debit. I'm going to reduce receivable by how much? And I'm going to increase cash by what? Now let's look for them. What happened again?
Salaries paid in the year.
Salaries paid in the year amounted to how much? You pay salary to cash, have you? Therefore, what happened to your cash when you pay salary? Yes. What happened to expense? Increase. Therefore, I'll come here. I'll come here and say payment of, okay, that's the rent. Let me do salary first. Payment of what? Salaries. When I pay salary, what happened to my cash? By how much?
Negative.
What happened to my salary expense account?
Increase.
Plus. Move. Which means the impact is my salary will go up, which is expense. My cash will what? Now, what again happened?
Rent and other expenses.
Rent and other expenses paid are how much? What happened to my cash again?
Goes down.
What happened to my rent expense?
Increase
By how much?
100,000
My rent will increase.
from 100.
And my cash will do what? Will reduce. By how much? Okay, what next? What did they say here?
30%.
That is payable or recoverable in what? Arrears at 10% of net worth. That's what. It means it's only when you make profit you pay back. If the profit is 0, 30% of you. If your profit, instead of profit, you have loss, you don't pay anything at all.
No, you should pay something.
No, in reality, it's based on, but we don't complicate it in that sense. That's tax. Now, but secondly, again, tax is not paid immediately. It's paid in what? Arrears, which means tax of this year now, we pay it next year, because for me to even know whether I make profit, this year must end. Therefore, we can't know whether there's tax until we prepare accounts, whether we are profitable or not. Now, let us prepare account. For us to prepare accounts, you generate your trial, you generate your what? Trial balance. Therefore, this is my trial balance. As at the end of the year.
Are you writing something?
Yeah. This is my trial balance at the end of the world. Okay, sorry, you have to, my brain is switching. I'm switching between the. Okay, you have your trial what? Balance. Can you see it here?
Yeah.
Now, what is trial balance? Trial balance is just a list of all balances after you have processed all transactions. The list of what? List all your asset lines, all your what? Equity lines, all your what? All your what? Income, and all your what? Expenses. Therefore, now, as at the end of the first year, what is my trial balance? You only call things that have balances. Once it's 0 balance, it doesn't show, because 0 is 0. It has no effect. Therefore, my balances for the first year are share capital how much? 1 million. Bank account how much? 650. Receivable how much? 300. That's the 300 you are looking for. 1,2,900. It shows customer is only owing me what? 300. As at the end of the year. And another balance I have is revenue, how much? 1.2. Cost of sales, how much? 1 million. Salaries and wages, how much? 150. Rent and other expenses, how much? 100. Therefore, I will now use trial balance to draw or present financial statement.
Why is the cost of sales same as cost of purchase?
Cost of sales is the same as cost of purchase. It's what you purchase yourself. And we are saying cost of sales is cost of what you purchase and sold.
That not with interest. Not with
Your profit is not big in your revenue. That's why you now compare the two to get gross profit. You see it. Okay. Hello? What?
She doesn't understand trial balance. The trial.
No. Trial balance is just a list of all accounts with balances. That's what.
Like what you did there to get to the closing balance, right? Like for all of the items.
All of the what?
All of the line items, like.
It's a summation now.
So
See, look at it.
So is it the balance from the beginning of the year?
Now, look at it. The beginning of the year was 0 because this is our first year. We just
But it, I think says opening balance.
that's why it's 0 because the company did not operate last year. Therefore, it can't have opening balance. The first time the company operated was this year when we introduced what? You can say that's why there was nothing here because it has never existed before. You will see second year now when the company has existed last year. We now carry balance of last year forward to what? To this year. But as at this year, there was no last year because this company was incorporated on 1st of what? January 27th.
So that 650K under cash tax bank would be the opening balance for 2018.
Yes, but we're not going to 2018. Let us close 2017 first. That's why we say this is our account balance, which is the closing balance as at when? 31st December 2017. And we only have balances for what? Cash. Balances for what? Receivable. Balances for what? Revenue. Cost of sales. Rent. Expense and what? Salaries and what? We now use those balances to draw financial statements.
I thought the accounting equation was asset to equity.
And like coming to that, when you see the equation, no, you see it, you see it. But our balance is just list of all accounts with what? Balances. All of them.
So your entry, like if you're in, is that what you call it your journal?
Yes. Or posting. Journal is another way of posting, but you don't use journal for day-to-day posting.
So I'm trying to practicalize it, particularly for us, right?
Yes.
That are doing MI. So typically, when we are getting the finance department, they will typically send us management accounts. Now, if I want to drill that down to see each line, so that if I want to understand the drivers of the business, I don't have to ask them to tell me. I want to just look at their bookkeeping records.
Yes.
Generate into that.
Now, you can do that. That's why if you have access to the ERP, they will give you a right to view, not a right to post. Then what you look for is one, you generate a balance. You generate what?
Balance like a summary.
Yes, that's a summary of. Now, when you say receivable, you can only have one receivable account, but there are 2,000 customers. You now have to go into the sub ledger. You know, everything you see here, I will call general what? Ledger. These are general ledger balances. General ledger is a summarized ledger where you might have 1,000 customers, but balances in each customer's account will be added together and it will show as if it's one customer. Now, for you to now see individual balances, you now have to go into the sub ledger. That's the subsidiary ledger, which is the main or original ledger where you have individual customers' accounts. You can see that. Also, if you go to revenue ledger, you will generate, if you go to revenue ledger, you will generate all transactions that make that revenue in terms of units, of items you sold, in terms of customer you sold it to, in terms of what? Price, and in terms of dates. That's why, that is where you will be doing more of analysis. That's where FP&A start from. It's not people posting that will do that. Because those ones are in financial what? Control. You are, their own output is your own what? Input. Where they stop is where your own work starts. Do you get that? And that is it. That's why probably later I'll show you rack. Some things you are going to generate those schedules. Schedules are generated from the sub-ledger and that's what you start to analyze. That's why you find out that in the Western world, they've automated most of the financial control aspects. which is posting and everything. What you now see most people is that you now have a plugin into the database to query data through SQL. Whatever you now query is what you now feed to people that will be doing analysis, predictions, forecasting, and the like. Does that make sense? Yeah. No, I thought, yeah, wanted. Okay, now let's see what happened now. These are all of the balances. Let us now prepare accounts.
Samuel, whose role is it to do this part you just done?
Which part?
Posting.
With the accounting guys about it.
So will I ever have to do that? Like if they tell me to analyze something?
No, you do
like,
that. No. Why we are doing what we are doing now is that for you to understand the effects of whatever transaction or action taken, that's why you are learning. You are not going to ever post or anything. But if somebody is telling you that the inventory went down because of this, you will be able to reason it out. Whether that person, you understand, you know why inventory should go down, why it should go up. That's what the objective of what we are doing now. If somebody just saying the revenue increases, you expect that it must increase because they've sold more.
They've increased prices.
Revenue is a function of price and quantity.
My own one.
Okay, now let me clean up this. Okay, I thought I'm using the right template. Okay, let me clean it up and we'll.
Sorry, this part. I'm guessing the solution from that.
I don't know, I'm cleaning them up. Okay. Okay, what was the first year, 2017, Abi? At the beginning of the year, there was no balance because it's a new company. All of these balances were nil because all of these balances here were nil because the company never existed last year. Now, the first balance sheet they ever produced was at the end of 2017. Now, the next thing you're going to do is that you just pick the balances one by one. The same thing you do in your income what? Statement. Let me come to income statement and also clean it up, and you see how we build it up.
you.